Good evening, all of you. So let's continue from where we left yesterday. Uh, we completed the definition of capital asset, definition of transfer. We completed the computation, how to compute capital gains. Okay. We actually saw the uh, format to compute the capital gains. So in that full value of consideration, we did that minus transfer expense. We did that also. Then after that, net consideration and minus cost of acquisition. We were doing cost of acquisition yesterday. So in cost of acquisition, we were doing this chart, if you remember, this chart, right? So we have completed so far till here, till 55 to double A, 55 to double A, right now. So 55 to double A talks about shares, bonus shares, rights, what will be the cost, what will be the period of holding and all that we have discussed yesterday. So one question I would like you all to solve with me today. Okay, but first that question I will dictate. You will write down that question and then we are going to solve that question together. Okay, write down. Write down the question, please. Give me 1 second. Huh? Write down. Mr. Abhinav. Mr. Abhinav acquired 10,000 unlisted equity shares, 10,000 unlisted equity shares of A Private Limited, on 12th of December 2000. On 12th of December 2000 for rupees 80 per share. For rupees 80 per share. Full stop. Brokerage paid at the time of purchase. Brokerage paid at the time of purchase was at the rate of 1%. Was at the rate of 1%. Full stop. He was also allotted bonus shares. He was also allotted bonus shares on 30th March 2001. On 30th March 2001. In the ratio of 1:1. In the ratio of 1:1. Full stop. Give a paragraph. Write down the FMV of these shares. The FMV of these shares as on 1st April 2001 was rupees 120 per share. Rupees 120 per share. Again, paragraph. Additionally, He was allotted 5,000 bonus shares. He was allotted 5,000 bonus shares on 18th August 2023. 18th August 2023. Full stop. He sold all the above 25,000 shares. He sold all the above 25,000 shares for rupees 450 per share. For rupees 450 per share on, now what you will write? After writing on, you will write two dates. A, first date, A, 18th April 2024. Or B, 21st of November 2024. Full stop. Brokerage paid at the time of sale of these shares. Brokerage paid at the time of sale of these shares was at the rate of 1.5%. Full stop. Compute the amount of capital gain chargeable to tax in the hands of what was the name of the assessee? Mr. Anirudh Abhinav. In the hands of Mr. Abhinav. Full stop. Did you write? Now, did you understand the question? We are supposed to solve this question now. Now pay attention, please everyone. Pay attention. This question is framed by me in order to test that whether whatever we have learned, how much we have understood. Okay. See, if I talk about the solution, okay, let us first assume, don't write anything. Don't write anything. Let us first assume that the shares are transferred on 18th of April 2024. 18th April is the date of transfer. So now you are having three, lots of the shares. You are not having all these 25,000 shares. You are not acquiring them together. 10,000 shares you are buying. Then again the another 10,000 shares you are receiving as what? As bonus shares. Then again once more you are buying. Once more 5,000 shares are received by you as what? Bonus shares. See, in all these three cases now, we have three lots. All the three lots are acquired at different time, at different cost. So their period of holding will be different. Because if I say the first 10,000 shares were acquired by you on 12th of December, meaning 2001. Okay. 12th of December, you acquired the shares. What was the cost of these shares for you? Come on, tell me. What was the cost of these shares? You acquired per share at 80 rupees. And at the time of acquisition, you gave 1% brokerage also. So 80 into 10,000 will give you 8 lakh. 80 into 10,000 will give you 8 lakh rupees. Plus 1% brokerage also you paid at that time on the selling price. So your actual cost of these shares was 8,08,000. Correct? No? Now wait. Did you acquire these shares on 12th December 2000? Yes. Have you acquired it prior to 1st April 2001? So you will get an option to take the fair market value also as a cost. So what was the fair market value of these shares? 120 rupees per share. So 120 into 10,000, you will get 12 lakh rupees fair market value. No need to add any brokerage etc. in this. This fair market value takes care of everything. Yes or no? Add brokerage only in the purchase price, only to determine the actual cost. Okay. No need to add it in the fair market value. Fair market value takes care of everything. So 8 lakh 8,000 or 12 lakh, you get the option to take the fair market value also as a cost if the shares are acquired prior to 1st April 2001. So which one would you take as a cost? Definitely, sir, 12 lakh you will take the cost. Did you get the cost of these shares? Now, these shares you are transferring on what date? 18th of April 2024. Along with 25,000 shares, these shares are also going. 18th April. So, date of transfer is 18th April. So, from here till here, will you get the period of holding of the shares? Now, tell me, the shares are transferred on or after 23rd July 2024 or they are transferred prior to 23rd July? Prior to 23rd July. Meaning that these are unlisted shares which are transferred prior to 23rd July. That time we used to check the period of holding as 24 months only. So is the period of holding more than 24 months? Yes. Then the lot, these shares are having the shares, this lot has the shares, all the 10,000 shares are what? Long-term capital asset held for a period of more than 24 months. And the cost also you came to know that this is the cost. Now will you index the cost? Yes or no? Now how that indexation takes place, that I have to tell you now. Okay, how the indexation takes place, that I will tell you, don't worry. But have you calculated so far? Okay, now pay attention. Now we will talk about 10,000 bonus shares. Why 10,000 bonus shares? You got the bonus shares in the ratio of 1:1, meaning that the date on which you got the bonus shares, on that date you were already the owner of how many shares? 10,000 shares. Now if you are the owner of 10,000 shares, you will get 10,000 more shares as what? Bonus, 1:1. So this you got on 30th March 2001. Same previous year, but on 30th March 2001. Meaning that these bonus shares were acquired prior to 1st April 2001. Prior to 1st April 2001, you acquired these bonus shares. So for these bonus shares also, their cost of acquisition will be either the actual cost or the fair market value, whichever is higher. So what was their actual cost? Bonus shares costed you nothing. Actual cost was nil. And the fair market value of these shares of A Private Limited was 120 only, no? At the time of 1st April 2001. Yes or no? So 120 I will take here also. Into 10,000 bonus shares, I will get 12 lakh rupees fair market value. So nil or 12 lakh, whichever is higher, 12 lakh will be the cost of acquisition. I will not take nil. Definitely, why would I take nil if I am getting the opportunity to take 12 lakh as cost? Since the bonus shares were acquired prior to 1st April 2001, their cost of acquisition will be either their actual cost, which is nil, or the fair market value on 1st April 2001. Everyone. So I will take 12 lakh as cost. Now, these bonus shares were acquired on this date, transferred on 18th April along with 25,000 shares. These 10,000 shares were also sold. 18th April. So their period of holding is from this date to this date. Is it more than 24 months? Yes. Why are you checking 24 months? You know the logic now. They are transferred prior to 23rd July and they are unlisted bonus shares. Hence we are checking 24 months. Okay. Now if this is more than 24 months, then whatever cost you have determined needs to be indexed also. Indexation you will get in the cost of acquisition. Yes or no? Now you have 5,000 bonus shares also. These 5,000 bonus shares were issued to you on 18th of August 2023. And these 5,000 shares also you sold on 18th of April. So all the shares are sold on the same date. Can you see? But the date of acquisition is different. Now check. for the last 5,000 bonus shares, your period of holding is not more than 24 months. It is less than 24 months. From 18th August 2024 to 18th April 2024. Hardly 5-6 months, 6-7 months. Yes or no? So is the period of holding more than 24 months or less than equal to 24 months? Less than equal to 24 months. This 5,000 shares, bonus shares, the lot, this entire lot and all the shares in this lot will be treated as short-term capital asset as of now, as on 18th of April. Now what will be the cost of acquisition of these shares? Are the bonus shares acquired prior to 1st April 2001 or on or after 1st April 2001? On or after 1st April 2001? So what will be the cost of acquisition? Their actual cost, which is nothing but nil. And here you are not going to get that option to take fair market value. Yes or no? So it's finally, its cost of acquisition will be nil only. Did you identify the cost for all the shares? Sure. Now pay attention. You have to now index them. Index the cost. Why? Since all the shares were transferred prior to 23rd of July. Now what is indexation? First of all, understand. I will write down one formula. See, before writing down that formula, I would like to tell you that indexation is a benefit. Indexation is a benefit because of which the cost is inflated, cost is increased. Now, if you go to your ICI study mat, in your ICI study mat, no, there is one indexation table which is given. Wait, I'll tell you. It is on what page? It is on page number 3.394. Can you see this table is given over there? Okay. Now what is this table? Come on. Please check what is the first year you can see over here. 2001 and 2. Okay. And what is the cost inflation index written in front of that? 100. So 2001-2 is kept as a base year. 2001-2 is kept as a base year. See, when we were students, no, in our time, our base year was different. In our times, it was 81-82. Yes, it was 81-82. But right now, the government has changed. Since many years, this has been changed. Okay. But the base year is changed to 2001, 2002. Now, if you consider base year 2001 and 2, the CII taken is 100. Meaning that if anything whose cost was 100 in 2001 and 2, this is the base year. And now inflation will be checked. Considering this as a base year, now the inflation will be checked. That same thing, the cost of the same thing became 105 in the next year. It became 5 rupees more costlier. That same thing, the cost of that thing became 109 in next to next year. Then it became 113. Then it became 117. Then it became 122. Likewise, see, the cost is increasing. The cost is increasing. And right now in 24-25, the same thing costs how much? 363. Almost 3.5 times more as compared to 2001-2. So that time, if something costed me 100 rupees, no, some asset, the cost of that asset was 100, no. Right now, today, the cost of that asset is 3.63 times more. That same thing will cost me 363 right now. What is the reason for that? Reason is inflation. And that inflation is counted here. This is an index showing your cost inflation. Hence, this index is known as cost inflation index. In reality, it is more. Okay. So, the government has prescribed this much only for capital gains calculation, sir. Okay. So, you are going and telling the government, in reality, it is more. So for you, we will not make a new income tax law, no macha? Income tax law is made common for everyone. Okay, everyone is following this according to us. This is the inflation. In reality, it is too much, we know. Sure. Now pay attention. Something which you acquired in 2001-2 is now worth 363. Now pay attention. I will give you one example. Okay. What is that example? If one capital asset I acquired, any capital asset, if I acquired in 2009-10, so the year in which I acquired was 2009-10, and at that time I acquired it for 4 lakh rupees. What was the CII in the year 9-10? Come on, let's check. CII in the year 9-10. Can you see? In the year 9-10, it was 148. So at that time, the CII was 148 in the year 9-10. Okay. So when CII was 148, that time I had incurred a cost of rupees 4 lakhs. Now the same asset which I acquired in 9-10, I am selling in 2024-25. So the capital asset which I acquired in 2009-10 is now being transferred in 24-25 when the CII is 363. So what should have been the cost of this asset today? Cross multiplication. As simple as that. Can you do it? So I will do 4 lakh into 363 divided by 148. I will get 9,81,081. 9,81,081 will be my cost. Meaning that if I go and buy this same asset today, I will get it for a cost of rupees 9,81,081. The asset which was costing 4 lakhs in 2009-10, its cost has come up. Its cost has increased to how much? 9,81,081 today. Now, if any asset which is a long-term capital asset, if any asset which is a long-term capital asset, over a period of time, there is an inflation in its cost. Some assets, you will see the inflation in their cost after 12 months. Some assets, you will see inflation in their cost immediately after 24 months. Some assets, you will see the inflation in their cost after 36 months. Real inflation starts in their cost. Hence, the period of holding is 12, 24 and 36 months for different types of assets. Getting my point? So whenever you acquire certain assets and you hold it for 12 months, those 4 assets, usually the inflation starts showing its effect on those assets after 12 months. Within 12 months it is okay, but after 12 months inflation starts showing effect. Those 2 assets, unlisted shares, immobile property, within 24 months, after 24 months, the inflation starts showing their effect. So whenever these assets are held for more than 12 months, inflation will start showing effect. We will be giving the inflation effect also. We will allow you to take the effect of inflation also in the cost. Take it. Inflate the cost. All other assets, the inflation affects their cost after 36 months. So hold them for more than 36 months. They will become long term. We will allow you to inflate their cost. We will allow you to index their cost. We will allow you to take the inflation as a factor to be included in your cost. Yes or no? Now that 36 months is no more in existence also, and for all the assets, the indexation is also taken away. But now see, if in the 2024-25 you transferred the asset for rupees 10 lakhs, why someone was ready to give you 10 lakh for that share, for that capital asset? If you acquired that asset in 2009-10 for 4 lakhs, no. So why someone was ready to give 10 lakh rupees for that asset today? Because of the inflation. The cost would have increased. And as a result of that increased cost, you are getting a higher selling price today. So if you reduce that cost which you incurred long back from this selling price, you will not get correct profit and gain. If you want to have correct profit and gain, both the amounts should be comparable. No, selling price is in today's terms. After considering inflation and everything, the cost would have increased. Hence, you are getting this much selling price. So bring your cost also to today's level. Bring your cost also to today's level by inflating your cost. So when you bring both the figures at today's level, only then it is going to give you correct profit and gains. Getting my point, everyone? So what will happen now? From 10 lakhs, instead of reducing the cost of 4 lakhs, now reduce the cost of 9,81,081. So you will not be given the deduction of 4 lakh, you will be given the deduction of 9,81,081. Tell me how much? It will be 189, 18,919. Just imagine your capital gain is only 18,919. If no indexation was given, it would have been 6 lakhs. And now they have done that only. But if you transfer the asset on or after 23rd July 24, now there will be no indexation, and what will happen? Whatever cost you incurred, that cost you reduce. Now just imagine, on this if 20% was applied, after taking indexation, your whatever capital gain was there, no, on that long-term capital gain, the rate of tax was 20%. So your tax would have been 3784 only. The tax would have been only 3784. Are you all getting this tax? Now just imagine if the indexation is not given. So we'll take the same selling price, 10 lakhs. Out of that, you will now reduce 4 lakh rupees cost, friends. And your capital gain will be 6 lakh. Madam Nirmala Sitharaman saying, see, we have taken away indexation from you, no? So your government is thinking too much about you. Don't worry. Your capital gain will be higher, no? So we'll compensate by giving a relaxation in the tax rate. Now your tax rate on the same long-term capital gain will be 12.5%. Apply 12.5%. 6 lakh into 12.5% will give you, still 75,000 tax. Just see the amount of tax which they are snatching from your pocket. And now this, see, because of the indexation, no, sometimes the assessee used to calculate the loss also. Sometimes, no, majority of the times the assessee used to calculate the loss also. Now there are no chances that he will get a loss. Very rare chances he will get a loss. Even if a small portion is considered as profit, on that we are getting 12.5%. In 100 transactions, only in 10 transactions the gain was happening, and then that gain was also not too much. On that we were charging 20%, this much high tax, and we were getting peanuts as what? Tax. Now in all the 100 transaction, majority of the transaction, almost 95% transaction, profit will be there. And that profit will not be a small profit, it will be huge profits. And on that, even if we charge 2 to 5% tax, no, still we are able to collect a huge amount of taxes. But see, still they have started charging 12.5%. How smart our government is. This is the way in which the indexation is done. Will you be able to do it? Now wait, please pay attention here. This happens. What you have done? You have taken the cost of acquisition. You have multiplied by the transfer year CII, and then you divide by the acquisition year CII. You got this amount. So can you derive a formula? cost of acquisition multiplied by CII of transfer year divided by CII of acquisition year. You will get index cost of acquisition. That formula is nothing but a simple cross multiplication. Yes or no? Now, if I change this example a little bit, you will go mad. See, if that same capital asset was acquired in 94-95, instead of 910, it was acquired in 94-95. For how much? 4 lakhs. And that is transferred in 2024-25. Yes or no? CII for the transfer year you will get 363. But CII for acquisition year will be missing. Because if you will see the CII table now, it starts from 2001-2 only. So Kaushik, if you have acquired the asset in 93-94, do we make a new CII table for you? Somebody would have bought the asset in 76-77. For them, do we prepare a new CII table? Different assessees would have acquired the asset prior to 1st April 2001 at different dates. So, do we have to prepare CII table for every year? No. The CII table will be common, having a common base year of 2001-2. Now, you have to see that when you acquired, did you acquire prior to 1st April 2001? Yes or no? When did you acquire? In our example, you acquired in 94-95. So, see, 94-95, when you acquired the asset, what was the cost of that asset at that time? 4 lakhs. Yes or no? Now, in the year 2024-25, you are selling the asset. That asset you are selling for 10 lakh right now. Hello, sir. But before that, there will be a date. Date will be 1st of April 2001. 1st April 2001. On this date, we will take the fair market value. The fair market value as on this date. For example, the fair market value was 4,60,000. Possible or not? In the year 94-95, you bought for 4 lakh. Now, there is a characteristic of the asset. Hello. Whenever you invest in a capital asset, no, the value of the capital asset slowly and gradually keeps on increasing. Yes or no? So, 93-94 you bought. By the time 2001-2 will come, its fair market value, its market value will increase. And it will increase to 4,60,000. Example. It can be any amount. It can be 5 lakh also. It can be 6 lakh also. It can be any amount. But in our example, we are taking 4,60,000. 55 subsection 2 clause B is giving you an option. What option? If you want, you can take this fair market value also as cost of acquisition. Why that option is given, you know? We cannot issue a new CII table for everyone. Because everyone, not necessarily that everyone would have acquired the asset in the same year, on the same date. There can be multiple, dates of acquisition. Very old assets can be there. Some asset can be acquired in 1960s. Some asset can be acquired in 1970s. Yes or no? Few of them will be acquired in 90s. Some assets in 80s. Maybe even prior to that also. We never know at what time you might have acquired the asset. Yes or no? But we have to keep one base year. That base year is fixed. April 2001 and 2 onwards. If that base year is fixed, then do one thing, no? Give the option to take the fair market value as at the beginning of that base year. What was the fair market value as at the beginning of that base year, as on 1st April 2001? It is 4,60,000. If we are giving you the opportunity to take this fair market value as cost, definitely you are going to take this fair market value as your cost of acquisition because it will be higher only. Hello? And in majority of the assets, it will be higher only. 99% cases, it will be higher only. And if we are giving you this option, you will definitely take this as a cost. Now tell me, don't you think any inflation which affected from 94-95 till 1st April 2001 is already taken care of in that fair market value? Now no need to give you separately indexation or no need to include inflation in your cost separately from 4 lakh onwards. Now what we are going to do, we are going to index, we are going to inflate this 4 lakhs till 24-25, because now we have CII from 1, 2 and onwards. Getting my point? Hello sir. So now what will you take here? Will you take cost or fair market value? Definitely you are not going to take cost, you are going to take fair market value 4 lakh 60 as on 1st April 2001. And now if you have taken it, do you have a CII? Yes. From here you have 100. So now do one thing. 460 into 363 divided by 100. Now you will get the index cost of acquisition. Do it. 1669,800. 1669,800. And see, you have transferred that asset for only 10 lakhs. Will it be a gain or loss? Now there will be a loss of 6,69,800. Long-term loss. What it, sir? Out of the selling price of 10 lakhs, you will be allowed the cost 4 lakh 60. No, 4 lakh 60 indexed. So the inflation from year of acquisition till 2001-2 also considered, fair market value given. Hello sir. And from fair market value onwards, meaning from 1st April 2001 onwards till 24-25, till that inflation is already considered. Now after considering the entire inflation starting from the year of acquisition till today, your cost will be 1669,800. Now that asset someone is buying from you for 10 lakh. Are you getting a gain or a loss? You are getting a loss of rupees 6,69,800. Now just imagine, if you are selling the same asset on or after 23rd July 2024, will you get index cost of acquisition? No, you will get only cost of acquisition 4,60,000. And in that case, you will have 5,40,000 of long-term gain. Just imagine, you were not supposed to pay a single rupee of tax because you were having a loss. Now because of the indexation taken away, what is happening? What is happening, guys? You are going to pay tax on? You are going to pay tax on 5,40,000. 10 lakh minus 4,60,000. And that too also 12.5%. How smart the government is. So, if I say formula, cost of acquisition, index cost of acquisition, you will take cost of acquisition, you will multiply CII of transfer year, and you will divide what? You will divide CII of acquisition year. But wait. If the acquisition year is prior to 1st April 2001, then for that year CII will not be available. Then in that case you will have to take the fair market value. Option will be given to take the fair market value, and you will divide the CII of 2001-2. If you acquired the asset on or after 1st April 2001, then only the acquisition year CII can be taken. So here now what we are going to do, CII of acquisition year or 2001-2, whichever is later. So if the acquisition year was 94-95, so take 94-95 or 1-2, whichever is later, 1-2. Divide the CII of 1-2, because you must have already taken fair market value by then. Hello sir. If the acquisition year was 9-10, so 9-10 or 1-2, take the CII of 9-10, because 9-10 is later than 1-2. Sure sir. Hello sir. This is the way in which the cost of acquisition must be indexed. Now coming to our question. Now tell me, these shares are acquired in 2001-2. 2001, prior to 1st April 2001, yes or no? prior to 1st April 2001, and you have taken the fair market value also as a cost. Hello, sir. Now, will you do the indexation? Yes. But to do that indexation, you now have cost multiplied by transfer year CII 363 divided by CII of which year? CII of 2001-2, because the acquisition was happening prior to 1st April 2001. Yes or no? So you will be taking the CII of acquisition year 2000, 2001, not available, sir. So take the CII of 1, 2, because you are taking the fair market value as cost. Getting my point, everyone? So what will be the cost of acquisition? 12 lakh into CII of transfer year. 12 lakh is your cost of acquisition multiplied by CII of transfer year divided by CII of acquisition year or 1 2, whichever is later. Acquisition year was earlier, 1 2 is later, so divide the CII of 1 2. Here also you will do the same thing. So 12 lakh into 363 divide by 100, 43 lakh 56,000. In both the cases you are going to get what? You are going to get index cost of acquisition. Now see, for these 5,000 shares, no, they are short-term capital asset. Whatever actual cost is there will become the cost of acquisition also. Will become the cost of acquisition also. You will not get any fair market value. You will not get the option to take fair market value as cost, because these bonus shares were acquired on or after 1st April 2001. So for them, their actual cost only will be taken as what? Cost of acquisition, which was nothing but nil. And see, you are calculating short term gain, no need to index also. And nil, if you index also, will remain nil only, no. First of all, nil cannot be indexed. After indexation, it will be nil only. And second, there is no need to index also. Why? Because the asset is short term. In short term capital asset, cost is never indexed. Yes or no? So what will be the cost? Nil. Without indexation, you will reduce. Now we are going to do the calculations. Come on. All the lots, separate assets. 10,000 shares, 5,000 shares. What is the full value of consideration? In the bracket only we are writing sale proceeds. Always have the habit to write in the bracket that what amount you are taking as full value of consideration. Because sometimes no, you will have to take specific amount as per specific section to be taken as what? FVC. So what amount you have taken here as FVC, if you show that in the bracket only, you don't have to write down a note separately for that. Getting my point? So in this case, we are taking the sale price only as what? Cost of acquisition. So sale price was 450 per share, 450 per share, 450 per share multiplied by number of shares. So we are getting 45 lakhs and 22 lakh 50,000 as full value of consideration. At the time of transfer, at the time of sale, are we paying any brokerage? Yes, we are paying 1.5% brokerage. So 1.5% of selling price, 1.5% of selling price, 1.5% of selling price. You will get 67,500, 67,500 and 33,750. This is your transfer expense. Any brokerage paid at the time of transfer by the transferor is his transfer expense will be reduced as a deduction. Now you will get the net consideration. Are you all getting it? What is happening? Plus minus you are supposed to do, simple. Now out of this, will you reduce cost or index cost? Everywhere index cost. First two cases index cost, last case cost only. Index cost what we have calculated, no? See, the same amount we are going to write here in the calculation. 4356 and nil. Here your capital gain will be 7600. This is your taxable long-term capital gain. And this is your taxable long-term short-term capital gain. Here the entire amount of net consideration will become your gain because there is no cost only. Getting my point? Did you copy this? Copy fast. Copy this fast. Done. Done. Now, give the next heading. If all the above shares are sold, if all the above shares are sold on 21st November 2024, then capital gains will be computed in the following manner. Then capital gain will be computed in the following manner. Pay attention now. When the shares are sold on 21st November 2024, what will happen? Is the transfer happening on or after 23rd July 2024? Yes or no? So the cost and everything remains same. But the only difference will be indexation benefit will not be available. Meaning that in the first and second case, what was the cost of acquisition which we determined? 12 lakhs, no? And the last case, nil. All of them will remain same. But without any indexation, they will be reduced. Now your cost of acquisition is reduced and see how much capital gain is coming. Now your long-term capital gain will be 64 lakh 65,000 in first two cases taken together. And last one remaining same, 22 lakh 16,250. So copy this part first. Write down note below this solution only. That note is relevant for this solution. Okay. In the above solution, write down in the above solution, even if the 10,000 acquired shares and 10,000 bonus shares are long-term capital asset, their cost of acquisition is not indexed since such shares are transferred on 21st November 2024, that is 21st November 2024, that is on or after 23rd July 2024, on or after 23rd July 2024, full stop. This is the note applicable only for this solution. Okay. Now what you will do, you will keep some lines blank to make this working note again, that you are going to do on your own now. Okay. But in this working note, what will change? See, this will remain same, but only the date of transfer you will change now. Date of transfer, instead of 18th of April, what will come? 21st November 2024. Yes or no, sir? You will change this only. Period of holding, this will remain same. No need to change. Cost of acquisition calculation will remain same. Till here everything will remain same. Only the date of transfer you are going to change. Yes or no? And don't write this. No need to do any indexation. That's it. And that we have not done. So below that note, you are going to make this same to same working note. That is your homework for today. Will you be able to do it? Everyone, now pay attention. One note, another note I am giving you. See, in this question which we have solved now, it tested almost all the concepts which we have studied so far in the chapter. Yes or no? Now, if in this question they have told you that 10,000 shares acquired, 10,000 shares bonus, again 5,000 shares bonus. So, how many shares you had? 25,000 shares. And the question told you that, sir, madam, all the above shares are sold. The question could have told you that out of all the above shares, 22,000 shares are sold. How many shares are sold? Then which 22? 10, 10 and 2000 out of last or. Second 10,000, then 5,000 and then 7,000 from the first 10,000. It can be in any permutation combination, sir. No. Always follow FIFO basis. What? Always follow FIFO basis. Meaning that the shares which you are acquiring first in the first lot. See, same company shares you can have multiple shares. Different company shares are different capital asset. Yes or no? But if for the same company different lots are bought, every lot will be considered as a separate capital asset. Every lot will be considered as a separate capital asset, and for every lot there will be different period of holding, different cost and everything. Yes or no? But in that case, it is not necessary that the shares, the total shares which you are having for a same company, but you acquired those shares in different lots, it is not necessary that you are going to sell all of them together. What if you are selling some part of the shares out of the total number of shares? What will happen? That time you will have to follow FIFO basis, meaning that if they are telling you that you are selling 22,000 shares, then first 10,000 shares are sold, second 10,000 shares are sold, and the 2,000 shares, extra 2,000 shares are sold from the last lot. Last lot was 5,000 shares. Yes or no? Out of that 2,000 shares are sold. Now 3,000 shares which are remaining in your stock, no, that is from those 5,000 bonus shares. Whenever you will sell them in the future, their period of holding will be started from the date of acquisition of these shares, bonus shares. Yes or no? Cost of acquisition will be taken as nil because that 3,000 is remaining out of the last lot. Getting my point? So write down a note. If the shares of a same company, important note, this is important note. If the shares of a same company are acquired in different lots, then each lot will be considered as a separate capital asset. Each lot will be considered as a separate capital asset. And at the time of sale of these shares, FIFO basis to be adopted. FIFO basis to be adopted. First in, first out. To determine their period of holding and their cost of acquisition. Will you remember this? Full stop. This is the end of the note. This is important note you are supposed to remember. Okay, no? Okay. Now pay attention. We are through with how many things? Many things we have completed, sir. Now come to this chart. Do you know in this chart now, section 55, subsection 2 we have done. In subsection 2 now, we are supposed to do AC. AC is remaining to be done. This part I am going to do later on when we will be doing long-term capital gain under section 112A. That I have already told you. Now if under section 55, can you see subsection 1? This talks about cost of improvement. This talks about cost of improvement. So now what is your cost of improvement? Okay. Cost of improvement means it is a capital expenditure. Cost of improvement means capital expenditure. 55 subsection 1 talks about cost of improvement means capital expenditure which is incurred on or after 1st April 2001, which increases the value of the capital asset. By incurring this cost, your value of the capital asset should be increased. Cost of improvement does not include expenditure of current nature like small repairs, then waterproofing, then coloring, etc., which does not enhance the value of capital asset. Meaning in the cost of improvement only capital expenditure will be considered. Which expenditure will be considered? Only capital expenditure. By incurring this type of expenditure, the value of the capital asset should increase. And this will be treated as cost of improvement only if it is incurred on or after 1st April 2001. Meaning that any improvement done in the capital asset prior to 1st April 2001 will be ignored. That is not treated as cost of improvement only. Only that capital expenditure which is incurred on or after 1st April 2001 will be considered as your cost of improvement. Why, sir? Simple logic. Simple logic. If you have incurred cost of improvement prior to 1st April 2001, definitely you would have acquired the asset prior to 1st April 2001 only. Isn't it? Will you acquire cost of improvement prior to 1st April 2001, but you have acquired the asset on or after 1st April 2001? Can it happen? No. So if you are incurring the cost of improvement prior to 1st April 2001, meaning that you have already acquired the asset before incurring this improvement. So if the improvement is incurred prior to 1st April 2001, definitely the asset would be acquired even before that. Meaning prior to 1st April 2001 only. So can I say if the asset was acquired, on 93-94, the cost of acquisition, meaning the actual cost which you incurred on the asset was 2 lakh rupees. Now tell me, for this asset, are you given the opportunity to take, option to take fair market value as on 1st April 2001? The asset which is acquired prior to 1st April 2001, for that, are you given the option to take fair market value? So the fair market value as on 1st April 2001, for example, this fair market value was rupees 5 lakhs. Meaning that this fair market value will take care of all the inflation happening on or before 1st April. Yes or no? Whatever inflation has taken place prior to 1st April 2001, from this till this, whatever inflation has taken place, that inflation will be taken care of. Now, is it the fair market value of your capital asset? Tell me yes or no. Is it the fair market value of your capital asset? Now, if you are incurring some cost of improvement, and that cost of improvement is incurred prior to 1st April 2001. So tell me, this asset, you improved the asset. The asset which you acquired in 93-94, you improved the asset. You incurred some cost on their improvement. For example, in 99-2000, you incurred some improvement cost. Improvement cost was 1 lakh rupees. So definitely now this fair market value will not be 5 lakhs. It will be the fair market value of an improved asset, which will be more than 5 lakhs. Hello sir. 5 lakh was the value when there was no improvement done. Now if you improve the asset, the fair market value will be of an improved asset, no? Hello sir. What if I say, cut. This is a building. This is a small building, small. Ground floor. Small house you have acquired for 2 lakhs. So this 5 lakhs, no, which was given here, sir, 5 lakh. 5 lakh was the fair market value of this same house. Hello. Now if you incur this improvement cost, meaning that you construct one more floor, you are constructing one more floor on the same building. Now the fair market value will be for that same building which you acquired, or it will be for an improved building. It will be for improved building, no? So definitely this fair market value will be higher than 5 lakhs. So it was, example, if it is 7 lakhs, meaning that this 7 lakhs takes care of inflation happened during this period. It takes care of this improvement cost also, which happened, improvement cost, and the inflation happened in improvement cost. Every damn single thing is taken care of by this fair market value. So if we are giving you that option to take this fair market value takes care of inflation. It takes care of improvements, whatever happened till this date. And if you are taking this cost, and again you are trying to claim the deduction of cost of improvement incurred prior to 1st April 2001, we are not going to give you. Ignore that cost of improvement. Hello? Ignore that cost of improvement. Only take that cost of improvement which is incurred on or after 1st April 2001. Getting my point? And even that cost of improvement will be indexed. How will you index the cost of improvement? Simple, same formula. COI. ICOI is equal to COI multiplied by transfer year CII. CII of transfer year. And what you used to do? Divided by CII of acquisition year, no? But now we are not indexing the cost of acquisition. We are indexing the cost of improvement. So we are supposed to divide the CII of improvement year, and this indexation will be done only if the asset is long term, and it is transferred prior to 23rd of July. Only then your cost of improvement will also be indexed. So a few example of cost of improvement. I have one building, I have made some addition to the building, meaning that I have constructed new floor, I have done some expansion work, I have done some heavy repairs work, heavy renovation work. As a result of these expenditures which I am incurring, the value of my asset will increase. Earlier I had only ground floor, now I constructed one more floor. Tell me, the area got doubled? Yes. And as a result of that, the value of my property will go up? No. So the cost which I incurred to construct that one more floor is my cost of improvement. If I have done some addition, if I have done some alteration, if I have done some expansion, extension cost, all these heavy costs which are not incurred on a daily basis, not incurred on a regular basis, are capital expenditures. If I incur such type of cost, they will be treated as my cost of improvement, and they must be incurred on or after 1st April 2001. Only then they will be treated as cost of improvement. Any cost of improvement incurred prior to 1st April 2001 will be ignored. Why ignored? Because the option to take fair market value is given. That fair market value which you are going to take as a cost, no, under 55(2)(b), hello, that fair market value will take care of this cost of improvement also. So forget about that cost of improvement. Now, whenever the cost of improvement is there, along with the cost of acquisition, that also needs to be indexed. If the capital asset was long term and you are transferring that asset prior to 23rd July, so prior to 23rd July 2024, if you have transferred the capital asset and the capital asset is what? Long term, both cost of acquisition and cost of improvement will be indexed. And how will you index the cost of improvement? Simple. Cost of improvement multiplied by CII of transfer year divided by improvement year CII. Meaning the cost of improvement which you incurred in the year 2009-10 was in the year 910, no? You have incurred the cost of improvement in the year 1920, 2 lakh rupees of cost of improvement you incurred. Now you want to bring that cost of improvement in today's terms. That if the same cost of improvement you would have incurred today in 24-25 when the asset is transferred, what would have been this cost of improvement now? Because of the inflation, your cost of improvement would have also increased, no? So why are you reducing that cost of improvement which you incurred in 1920? Bring that cost of improvement also in today's terms by including what? Inflation there. So 1920, what was the CII? In 1920 the CII was 289. So the cost of improvement was incurred when the CII was 289. Now the CII is 363. When the CII was 289, that time improvement cost was 2 lakhs. Now the CII is 363. How much should be the improvement cost? 251,211. 251,211. This should be your cost of improvement, index cost of improvement. This you reduce. But this indexation will happen only if the asset is long term and transferred prior to 23rd July. And if the transfer is not taking place prior to 23rd July, transfer is happening on or after 23rd July, then silently reduce 2 lakh only. There will be no indexation benefit available for cost of acquisition as well as cost of improvement. Hello sir, will you remember? So this was your cost of improvement, my dear friends. Okay, so with this we have come to an end the first part of the chapter. What was that? What was that first part of the chapter? Basics. Now see the question which we solved, no, the question which I dictated. In that same question, what changes they can do? Instead of shares, they can give you jewelry. Instead of shares or jewelry, they can give you immobile property. Now, immobile property they will give you. They can give you purchase prior to 1st April 2001. Kaushik, you were sleeping in yesterday's lecture or what? Huh? Indexation benefit is always available at the time of calculating the tax liability. And when you are a resident individual, calculating the tax liability at that time to calculate your tax, we will consider indexation. Otherwise, indexation is not available at the time of computation. I have told you this thing multiple times yesterday. Computation will be done without indexation if the transfer is after 23rd July. No need to give any indexation. If you are a resident individual or HUF, transferring your immobile property which you acquired prior to 23rd July, but you are transferring after 23rd July, still the computation will be made without indexation. Show your capital gains in the total income without indexation. When you will calculate the tax on that, calculate tax at 12.5%. But at that time you will be given the option to calculate tax at 20%. Calculation of tax at 20% will happen on the long-term capital gain computed after taking indexation benefit. Understanding? Next one. See, cost of improvement done. Okay, basics done. Now what they can do, they can give you some immobile property in the question. Immobile property acquired this date. Maybe prior to 1st April 2001 only they will give. So that they can put you in trouble to determine the cost. Actual cost will be given. Some brokerage etc. will be given, and they will give you the fair market value on 1st April 2001. Also along with that they will give you the stamp duty value as on 1st April 2001. So first of all you will have to determine the cost properly. Once you determine that cost properly, done. No problem in that now. Now what will happen? Now they will tell you in that same question, they will tell you that there are multiple improvements happening in this immobile property. One improvement or two improvements they will give prior to 1st April 2001. Ignore all those improvements. One or two improvements happening on or after 1st April 2001. And then there will be selling price and everything, transfer expense and everything will be given. And you will be told to calculate the capital gains. And also calculate the tax liability. Transfer date will be prior to 23rd July, then indexation will be taken. Transfer date on or after 23rd July, then there will be no indexation. But wait, when you calculate the tax liability, that time calculate 20% tax on what? On the asset. After taking, on the long-term capital gain after taking indexation benefit. That will happen only at the time of calculating the tax liability. This kind of simple question they will ask. Whatever you have studied, no, you will get that thing only in the question. So the more questions we will solve, the more confidence we will get. One question, did you solve, did you understand everything? So now we are moving on to the second part of the chapter. Second part of the chapter is specific charge. Okay, basics we have understood. So basic questions on capital gain will not be much of the problem for us. But practice will be required. Okay, no? Now pay attention. Can you see specific charge? Second part of the chapter. Now in specific charge, how many sections we are supposed to do? We are supposed to do only 3 sections. 45(1)(a), 45(2) and 45(5). But additionally we are going to do 2 more sections. That is section 46 and 46(a) also together with specific charge. Okay. So one by one we are going to finish all the sections, very important sections and very easy sections also. Okay. Now in the specific charge they are saying that, see, there is one specific charge given under section 45(1)(a) which says that any profit and gain arising on receipt of insurance claim. Now, why will you receive insurance claim? Come on, tell me. Receipt of insurance claim due to damage or destruction of capital asset. And how your capital asset will damage or destroy? It can destroy because of NRFE. Damage or destruction of capital asset due to NRFE. What is the meaning of NRFE? N for natural calamities, R for riots or civil disturbance, F for accidental fire or explosion, E for enemy attack. N for natural calamities, R for riots or civil disturbance, F for accidental fire or explosion, and E for enemy attack. Enemy attack with or without declaration of war. Now these are some reasons because of which your capital asset got damaged or destroyed. And these are all the reasons, these are all the risks which are covered by the insurance company. Insurance company gives you insurance to cover these risks. Your capital asset has these risks. Your capital asset can be damaged or destroyed by these reasons. So insurance companies normally covers these type of risks associated with your properties, associated with your capital asset. Yes or no? You are afraid that God forbid if some natural calamity happens or some riot or civil disturbance happens or some fire or explosion taking place or enemy attack is taking place, as a result of that my capital asset may be damaged and it is very valuable asset. So let me not take any chance or risk. Let me call the insurance company and tell the insurance company to cover all these risks. So you call the insurance company, told them that you want to take insurance of your capital asset covering all these risks. Yes or no? Now what will happen if the insurance company gives you insurance? So they will take under their risk. Now it will be their risk to cover all such unforeseen events. Because of such unforeseen events, if there is any loss happening to you, now you will be compensated. Insurance claim will be given. See, this is in nobody's control, okay? It is not in your control and neither in the control of the insurance company. But still these kind of things can happen, no? Now tell me, if your asset you acquired 10 years, 20 years back for 2 lakh rupees only. What was the cost of your asset? 2 lakh. 20 years back you acquired. Right now you are taking the insurance. After 20 years, today you are taking the insurance. Will you take the insurance of only 2 lakhs? Or will you consider the market value of your asset right now? So considering the fact that the market value of the asset today will be way more higher as compared to the cost which you had incurred. Yes or no? For example, today the market value of that asset was 50 lakhs. Not 50 lakhs, it will be too much. But for example, the market value was 25 lakhs. Tell me, 25 lakh is the market value of your asset right now. Will you take insurance just for 2 lakhs? Or the insurance company will come. They will value your asset. Valuation will be done. And based on that value, which their valuers will come and determine, they will grant you insurance for that value. And that value will be very nearby to the current market value. So for example, you took an insurance of 20 lakh rupees. How much? 20 lakh rupees. Meaning the risk covered is 20 lakhs. If something happens to your asset, you can be compensated till 20 lakhs rupees. You can incur a loss of 20 lakh rupees. To that extent, your loss will be given by the insurance company. Still, this is more than the cost only. God forbid if anything like this happens. Loss happened. Now insurance company will come and they will give you 20 lakh rupees of claim. Insurance claim, insurance compensation. Will you remember this? Isn't it more than the cost? Is it more than the cost? Profit is happening, no? Gain is happening, no? So pay tax on that gain. If the same profit you would have earned by selling the asset for 20 lakhs, would you have paid tax on that gain under the head capital gains? Then why not now pay tax on this gain? And the gain is happening not because of damage or destruction. No. Damage and destruction can never result into gain. The gain is happening because of receipt of that insurance claim. Meaning that the charge under 45(1)(a) will be created only if the insurance claim is received. Only then 45(1)(a) will come into picture. What if insurance claim is not received only? Then the entire damage or destruction is your dead loss, no? Hello? There will be no 45(1)(a) implications. This charge will not arise only. This charge arises only if on damage or destruction you are receiving what? Insurance claim. And because of that insurance claim, profit or gain arises. And that is going to arise. Why? Because the insurance claim, you are not going to receive the amount which you had incurred as cost few years back. The insurance claim will be received considering the market value of the asset at the time when it was lost. Sure, sir. Should I move ahead? So, for example, insurance claim right now received 20 lakhs. And as a result of that, this charge is created. So, now the profit and gain which is arising, even this profit and gain shall be taxable. Now see, this is not a normal profit or gain arising on transfer of a capital asset. There is no transfer happening. There are two parties, voluntarily asset transferred from one party to another party for a consideration, change of ownership taking place, change of possession. No, this is not an ordinary transfer. But still, it has to be considered as a transfer. So what type of transfer is taking place, The moment the asset gets damaged or destroyed, asset ceases to exist. Asset no more remains. So your right in that asset also extinguishes. So at the time when there will be damage or destruction, what did I say? At the time when there will be damage or destruction, at that time there will be extinguishment of what? Right. Extinguishment of right, my dear friends, is equal to transfer. And your capital asset, here damage or destruction is taking place, meaning transfer is taking place on damage or destruction. But the year in which the transfer is taking place, extinguishment of right is happening, damage or destruction is happening. In that year, the profit and gain, in that year 45(1)(a) is not charged. 45(1)(a) is charged in the year in which the insurance claim is received. So the profit and gain which will be arising will be taxable as income. Under the head capital gain, but it will not be taxable in the year of transfer. This will be taxable in the previous year in which insurance claim is received. And by the way, the year of receipt of insurance claim is not the year of transfer. Year of transfer is year of damage or destruction, because that is the year when your asset is going away. And your asset is going away. Asset is going away, meaning damaged or destroyed, meaning extinguishment of right happening in some other year. It is not necessary that in that same year you are going to receive insurance claim. Insurance claim can be received on a later on year. So the charge will be created. The charge will be created in the year in which you are receiving insurance claim, and that will be the year in which this gain will be taxable, and not in the year of transfer, not in the year of damage or destruction. So in order to make you all understand what I mean here, let us take one example. And that example is as good as a question on this concept which we are going to solve. Okay. But wait, do you have a capital asset? Yes, you have a capital asset. Is it getting damaged or destroyed? Yes. Damage or destruction means capital asset ceases to exist. So there is no capital asset. So as an owner, your right in that asset also got extinguished, no? So there is extinguishment of right happening on damage or destruction. And that extinguishment of right happening on damage or destruction is nothing but your transfer. If you remember the definition of transfer, the term transfer as per 247 includes sale, exchange, relinquishment of capital asset, or extinguishment of right in a capital asset is also a transfer. So this is a transfer happening in the year of damage or destruction. Yes or no? Now tell me, if I'll give you one example, okay? We'll take the same example which is given there in my notes. See this example. This example, we are going to solve this example proper in the question answer format. Okay, no? Question will be there in the exam. From that question, we are supposed to take out this information. What is the information given in the question? For example, there is one assessee. He is having one immobile property. An assessee having some immobile property which he acquired on 1st November 2014. So date of acquisition of the immobile property given. When the immobile property was acquired, it was acquired on 1st November 2014, meaning previous year 14-15 he acquired the property. At what cost the property was acquired? It was acquired for 10 lakhs. All these details will be given in the question. There will be nothing which will not be given in the question. You just have to take out the correct information to calculate your capital gains. Yes or no? Now what happened? The assessee incurred 1 lakh rupees cost of improvement on this asset on 16-17. In 16-17, no? 1 lakh rupees cost of improvement also incurred by assessee. Now, after some time, what is happening? Assessee has taken the insurance of this asset to cover up the risk of NRFE. These risks, to cover up these risks, the assessee has taken the insurance also. It is given in the question. Now that unforeseen event took place. For example, natural calamity took place. And natural calamity took place on 15th of December 2019. And as a result of that natural calamity, that asset, that immobile property got damaged or destroyed on 15th of December 2019. On that date, the fair market value of that immobile property was 25 lakhs. It is given that the value as on that date was 25 lakhs. Fortunately, the insurance was taken. And the valuers came and they determined the loss at 24 lakhs, which was given as an insurance claim to the assessee in the year 24-25 on 12th August 2024. Damage destruction happened in 1920. Damage destruction happened in 1920. Asset gone. So you are holding the asset only for this period. After that, there is no asset. Transfer is happening in 1920. Asset is going away. Extinguishment is happening in 1920. Asset is transferred in 1920. But the insurance claim, till the time you don't receive the insurance claim on this damage or destruction, 45(1)(a) will not come into effect. 45(1)(a) will not be coming into existence. Hello? And due to some technical reasons, no, you did not receive the insurance claim in that same year. To get the insurance claim, it took some time. But for that damage or destruction, you are receiving insurance claim in previous year 24-25 on 12th of August 2024. Wait. Can you see this date is on or after 23rd July? No need to do anything with this date because this is not the date of transfer. This is the date of transfer, which is prior to 23rd July. Hello? If the asset is long term, no, indexation will be done both for cost of acquisition and cost of improvement. Getting my point? Now, did you understand the entire question? Tell me. Now, how much claim you are receiving? 24 lakhs. How much claim you are receiving? 24 lakhs. But the value of the asset as on the date on which it got damaged, fair market value was 24 lakhs. It was, 25 lakhs. Asset is going. Tell me yes or no. Asset is going. What is coming? 25 lakhs is coming or 24 lakh is coming? Asset is damaged or destroyed. As on that day, the fair market value was 25 lakhs. Are you receiving 25 lakhs or you are receiving only 24 lakhs? So, to calculate this capital gain on the transfer of asset, whatever is coming, only that will be treated as full value of consideration. No. Then why this fair market value is given? To confuse you. That by mistakenly, if you take this fair market value as what? Full value of consideration, no, you are gone. Now, entire question we have understood. Hello. Now we are supposed to compute the capital gain. Okay. Sure. Ready. One by one. You will write the name of the assessee, status, PAN, previous year, assessment year, all these details you are writing. Okay. Then after that, the first thing which you will write will be computation. Computation of what? Dash term capital gains. It can be short term also, it can be long term also. But right now I am not aware. This will be depending on the period of holding of the capital asset. Yes or no? Hello? But in order to determine that what type of gain we are calculating, we are supposed to make a working note. The first working note will be to determine the period of holding, the type of capital asset and the nature of capital gain to be calculated. In that first working note, we are supposed to do that. And only after completing the first working note, we are able to write down here what? The gain calculated is long term or short term. Every damn single question you are supposed to do that working note. Without that, please don't start your question. Don't start your solution. Okay. Now wait. I know that I can solve this question in 6 to 7 lines maximum. Particulars and amount. So 6 to 7 lines, my answer will come. And the format is fixed, no? First of all, what I'll take? Come on, tell me. Full value of consideration. Less what? Less transfer expenses. Any expenses on transfer happening, I will reduce. Then I will get net consideration. Out of this net consideration, I will reduce two things. Cost of acquisition, cost of improvement. Now, I will not write down anything over here, because it can be with indexation also, it can be without indexation also. That I'll come to know after working note 1 only. But I know that cost of acquisition and cost of improvement is going to come. Okay, no? So for that, I'll keep 2 lines blank. Then, here I will get my capital gains. Either short-term gain, short-term loss. Long-term gain, long-term loss. Anything will be there, will be my final answer. Okay, no? Now, working note number 1. Note number 1. Note 1 will be for period of holding, comma, type of capital asset and nature of capital gain. So always give the heading to your note that what you are going to do here in this note. Okay, no? What type of asset you had, friends? What type of asset? You had jewelry which got damaged or destroyed? You had shares or you had immobile property? Yes. Always identify your asset, because only then you will come to know how much period of holding you are supposed to take. 12 months, 24 months or 36 months. Yes or no? So what was your capital asset? Come on, tell me. The capital asset was immobile property. See, the capital asset was immobile property. 1/11/2014. So its date of acquisition was 1/11/2014. Now tell me, this capital asset you are holding till what time? Till 24/25, no? Or till the date of damage or destruction? Simple, the moment it got damaged or destroyed, it went away, no? So I was holding the capital asset till the date of damage or destruction. Hello, sir. So can you see the damage or destruction date? 15th December 2019. My capital asset period of holding will be till damage or destruction only. If you take any day after that, you are gone. So period of holding will start from date of acquisition and it will end on date immediately preceding to date of damage or destruction. Okay, no? So tell me, damage or destruction. This happened on 15th of December 2019. Okay, perfect. Now, see, the property was immobile property. This is the period of holding of immobile property. Now tell me one thing. Are you considering this date? Are you considering this date as your date of transfer? This is considered to be date of transfer. Now check. The date of transfer is prior to 23rd July 2024. Isn't it? Is this date prior to 23rd July 2024? Yes, sir. So if any immobile property which was transferred prior to 2024, what used to be the period of holding? 24 months. Even if this damage or destruction would have been on or after 23rd July 2024, no. For example, instead of 15 December 19, the date was 15 December 2024. That means the transfer is taking place on or after 23rd July 2024. Still, I would have checked 24 months only. The assets whose period of holding was 36 months, that period is now taken as 24 months. Yes or no? But for immobile property, earlier also it was 24 months, now also 24 months, meaning if the transfer is made prior to 23rd July, 24 months, and if this transfer would have been made, if the damage or destruction would have been done on or after 23rd July 2024, still I would have taken 24 months only. Is the period, check the period, is the period more than 24 months? So I will write down period of holding greater than 24 months. Therefore, CA is LTCA and CA is LTCA, meaning the capital asset is long-term capital asset and long-term capital gain to be computed. What have you done? You have determined the period of holding, you have determined the type of asset, and you are determining the nature of capital gain to be computed. So now, in your statement above, fill in the blanks is there. What type of capital gain you are calculating? Long-term capital gain. This you came to know from note number 1. Yes or no? Now to determine the long-term capital gain, we usually index the cost. But the index cost of acquisition will be reduced only if the transfer is taken prior to 23rd July. In my case, it was prior to 23rd July only. Yes or no? So will I take the index cost? So I will write down index cost of acquisition, index cost of improvement. Now I'm ready with my format. Now tell me, do you have full value of consideration? First of all, tell me what type of transfer this is. This is a normal type of transfer or damage or destruction? So damage or destruction will result into gain. No, damage or destruction is not going to result into gain. Insurance claim received on this damage or destruction will result into gain. Yes or no? So are you getting any insurance claim? Tell me yes or no. When are you getting that insurance claim? That insurance claim you are getting, sir. That insurance claim you are getting on 12th of August 2024. Please check. How much amount you are getting? 24 lakhs you are getting. So the year in which you are getting 24 lakhs. The year in which you are getting that 24 lakhs. In that year only, the capital gain will be calculated under section 45(1)(a). And in that year only, that capital gain will be taxable. But to calculate that capital gain, what will be your full value of consideration? The amount of insurance claim only will be taken as your full value of consideration to calculate capital gain under section 45(1)(a). So whenever you are going to calculate the capital gain under section 45(1)(a), always you are supposed to take what? The amount of insurance claim only as your full value of consideration, because the gain arises on receipt of this claim only. Getting my point? So what is the amount of insurance claim? 24 lakh. This will be deemed to be your full value of consideration. So here now in our solution, this FVC you can see, we will open a bracket and we'll write insurance claim under section 45(1)(a) is deemed to be the full value of consideration, which we are taking here as full value of consideration. Asset is going, apply some mind, asset is damaged or destroyed. What is coming? Insurance claim. So that should be the full value of consideration. Common sense. Hello sir, how much was that? 24 lakhs. Akshaya, you are looking in tension today. Everything all right? Akshaya? Everything all right? You are appearing tensed. Akshaya? Yes. Miss Ravichandran, I am asking you. Everything all right? Sure, no? Understanding? Raj Lakshmi? Are you present? Or playing with kids? 24 lakhs. Okay. 24 lakhs minus any transfer expense happening. Just imagine damage or destruction is transfer. Will you incur expenditure to damage or destroy the asset? Will you incur any expense on transfer? No. And in the question also, there was no discussion about transfer expense. So transfer expense will be dash. So reduce dash out of 24 lakhs. Net consideration will be 24 lakhs. Yes or no, sir? Yes. Now, cost of acquisition or index cost? Index cost. But for that, we will have to first calculate the cost of acquisition. So for this, we are going to do note number 2. Note number 2. And for index cost of acquisition, we are going to do note number 3. Okay. So come to note number 2. In the note number 2, we are determining what? Cost of acquisition and index cost of acquisition. COA and ICOA. Tell me, what will be the cost of acquisition? Look at the question. Come on. Look at the question and tell me what will be the cost of acquisition. 10 lakh only, which is nothing but the actual cost. And actual cost of the asset will be taken as cost of acquisition if the asset was acquired prior to on or after 1st April 2001. So when the asset was acquired, come on, tell me. Asset was acquired in 14-15, meaning on or after 1st April 2001. So whatever is the actual cost of the asset, that actual cost only we are going to take as what? Cost of acquisition. That was 10 lakhs. So cost of acquisition, sir, is equal to actual cost, and which is nothing but 10 lakhs. Now will I index it? Yes. Index cost of acquisition is equal to cost of acquisition into CII of year of transfer divided by CII of year of acquisition. Wait, sir. Wait. Please pay attention over here. I will write 10 lakh over here. Any problem? Hello? Any problem? No problem. Multiplied by CII of transfer year. Come on. Tell me, when did I transfer? The year of damage or destruction, the asset got transferred. Yes or no? So the year of transfer is not 24-25. 24-25 I am receiving insurance claim. The asset got transferred in the year in which it got damaged or destroyed. So what is the year of damage or destruction? 1920. 1920 is the year of transfer. So multiplied by CII of year of transfer, meaning CII of year of damage or destruction. Yes or no? So can you tell me CII of damage destruction year? It is 289. CII table from your ICI study mat. Please check. 1920. CII is 289. So this is the CII of transfer year divided by CII of the year of acquisition. In which year you acquired? 14-15. Can you tell me the CII of 14-15? It is 240. So now 10 lakh into 289 divided by 240. Are you going to get 12 lakh 4,167? This is your index cost of acquisition. Sir, in your answer, 12 lakh 4,167 will be your index cost of acquisition from note number 2. Done, sir? Now note number 3. Very easy. Note number 3 will be for COI and ICOI. Tell me, cost of improvement will be actual amount on or after 1st April 2001. Actual cost of improvement. That was how much? 1 lakh, no? In the year 16-17. So cost of improvement in the year, previous year 16-17, incurred how much? 1 lakh. Will this be considered or will not be considered? Yes, this will be considered. If this would have been incurred prior to 1st April 2001, I would have ignored it. Okay, and in that case the asset would also have been acquired prior to 1st April 2001. Got it, sir? So now I will take this 1 lakh, but I will have to index this also, no? So what will be the formula for indexing? Index cost of improvement is equal to cost of improvement multiplied by transfer year CII, CII of transfer year. Divided by CII of year of improvement. So cost of improvement is 1 lakh. Transfer year CII will remain same, 289. Now the improvement year CII will change. Improvement is happening in which year? 16-17. What is the CII of 16-17? Come on, tell me. You're supposed to give me the correct CIIs, huh? 264. Now can you index 1 lakh into 289 divided by 264 will give me 1,09,470. 1,09,469 point something means 470. So I will go and write down 1,09,470 over here. 1,09,470. Yes or no? Now 24 lakhs minus 12 lakh 4,167 minus 109,470. You are going to get 10 lakh 86,363. 10 lakh 83,000, 86,363. Can I say this is your taxable LTCG which you have computed as per section 45 1A? This is not your normal capital gain. This is a capital gain which you have calculated as per the provisions of 45 1A. This is the capital gain arising on receipt of insurance claim on damage or destruction of your capital asset. Now tell me, in which year this will be taxable? The calculation you are doing, and you are taxing this capital gain in which year? In the year of damage or destruction only, no? In the year of damage or destruction, you are going to calculate and you are going to charge this, no? No. This capital gain is not taxable in the year of transfer. This capital gain is not taxable in the year of damage or destruction. This will be taxable in the year in which the insurance claim is received. So this entire calculation and the taxability of this capital gain will happen in previous year 24-25 because that was the year in which the insurance claim of 24 lakh was received. Yes sir, no sir. So can you see one line blank above? So here I will write this computation and taxability in previous year 24-25, that is assessment year 25-26. Why you are taxing it in this year? Because the insurance claim is received in this year only. The year of receipt of insurance claim is the year in which the capital gain under section 45 1A shall be charged to tax, and that amount is how much? 10,86,363. Is it difficult? Sure. Pay attention. What is the answer given? And whatever discussion is there, no? See, the entire discussion we have done in the question solution itself. What will be the full value of consideration? From where to where the period of holding will be taken? If that period of holding is short term, there will be no indexation. Based on the period of holding, if the asset is long term, we will be doing indexation if the transfer takes place, damage or destruction takes place prior to 23rd July. All this discussion we have done. Hello sir. So one by one. Pay attention. Any profit and gain arising on receipt of insurance claim on damage or destruction of capital asset due to NRFE. Due to these reasons, my capital asset is damaged or destroyed. So on that damage or destruction, capital gain will not arise. Capital gain will arise on receipt of insurance claim. Till the time insurance claim is not received, you will not invoke this section. Meaning that you did not take the insurance only and asset got damaged or destroyed. Will you come and calculate this gain? No. The entire amount is your dead loss now. No need to calculate this gain. This gain is not calculated just because damage or destruction is taking place. Yes or no? What if you have taken the insurance? Will you calculate this gain? Not till the time you are not receiving insurance claim. Just because taking the insurance will not allow you to get that insurance claim also. Sometimes the insurance company rejects the claim also. So damage or destruction taking place, asset is transferred. But the gain will be calculated and will be charged to tax in the year in which the asset is damaged or destroyed? No, the year in which the insurance claim is received. In this year, the gain will be taxable. And in order to charge this gain under section 45 1A, what will be the full value of consideration? Come on, tell me. What will be the full value of consideration? The amount of insurance claim will be taken as full value of consideration. So whatever money value which you are receiving as what? Insurance claim will be treated as your full value of consideration. But sometimes the insurance company can also give you. In our example, we saw that they are giving you 24 lakh rupees as what? Insurance claim. 24 lakh rupees as your insurance claim. Yes or no? But they can give you some asset also. So now on damage or destruction, what you are receiving? Are you receiving cash? No, you are receiving some asset. So the value of that asset is your insurance claim. Hello? Now the insurance claim is received in kind, in the form of some asset. So the value of that asset which is coming is your insurance claim. Take that amount as your full value of consideration. Getting my point? Will you understand? So always the capital gain under section 45 1A will be calculated. This amount will be taken as your full value of consideration. Yes or no, sir? Now what will be the period of holding of that capital asset which got damaged or destroyed? You will start that period of holding from the date of acquisition of that asset. And the period of holding will be taken till the date of damage or destruction only, because after that you are not holding the capital asset. Hello? Already the extinguishment has happened. Transfer has taken place till the year of damage or destruction. So from the date of acquisition till the date immediately preceding to date of damage or destruction, this is the period of holding which you are supposed to consider. Now based on this period of holding, if you come to know that the asset is what? Short-term capital asset, cost of acquisition, cost of improvement of that asset will not be indexed. No indexation will happen. But based on that same period of holding, if the asset is long-term capital asset, then cost of acquisition, cost of improvement, both will be indexed if the damage or destruction is happening prior to 23rd July, which happened in our case also. Damage destruction happened in 1920, meaning prior to 23rd July. Yes or no? But if the damage or destruction is happening on or after 23rd July, in that case, even if the asset is long term, cost of acquisition, cost of improvement will not be indexed if the damage or destruction happening on or after 23rd July. Hello sir, will you remember? And how will you index the cost? If here indexation needs to be done, how you will index the cost? You will take the cost of acquisition multiplied by CII of which year? Transfer year, meaning the year of damage or destruction, divided by CII of acquisition year. How will you index the cost of improvement? You will take the cost of improvement multiplied by CII of transfer year. The year of damage or destruction is the year of transfer. Multiply the CII of that year and divided by CII of year of improvement. Hello sir. Will you remember? Sure? Paka? Okay, perfect. And applying this logic only, we solve the question. See, all the things which are given in the theory over there, we have already applied all those things in our solution. So now are you all understanding what is happening around you? Tell me. Okay. Now pay attention. Pay attention. Capital gain is 10,86,000. Now if I twist this information a little bit for you, twist little, can I? In the question, what is the date of damage or destruction? 15 December 2019. Let's assume that this date is 15th December 2024. Assume. And the insurance claim you received on 12th of January. This date, let's assume that this is 15th December 2024, damage or destruction. And the insurance claim, no, you received this insurance claim, example, 12th of February 2025. Possible or not? Now tell me, what is the date of damage or destruction? Before 23rd July or on or after 23rd July? On or after 23rd July. This is the date of transfer. 15th December 2024 is the date of transfer. Is it prior to 23rd July 24 or on or after 23rd July? Yes. Now what will happen? The same calculation will happen. What FEC you will take? Insurance claim 24 lakhs. Transfer expense nil. Net consideration 24 lakhs. Okay. Even your asset is a long-term capital asset because the period of holding will start from 14-15 till 15th of December 2024. The period of holding is long-term. Yes or no? But the cost of acquisition, cost of improvement, 10 lakh and 1 lakh will not be indexed. It will be reduced without taking any indexation. So out of 24 lakh, you will reduce 10 lakh. Out of 24 lakhs, you will reduce 1 lakh. Hello, sir. So how much you will get? How much you will get? 24 lakh minus 11 lakhs. 10 lakhs cost of acquisition, 1 lakh cost of improvement. How much you will get? 13 lakhs. 13 lakhs will be your long-term capital gain. Long-term capital gain without taking indexation. And this 13 lakh will be taxable in that same year only. Why, sir? Because in that same year you are getting the insurance claim also. 12th of February 2025. Now, what will be the tax rate on this gain, sir? Capital gain will be 13 lakhs only. In the computation of total income, long-term capital gain, you will show 13 lakhs only. The tax rate will be 12.5%. But wait, is it an immobile property? Yes. Are you a resident individual? Yes. Long-term capital gain on immobile property will be calculated by taking what? Indexation also, and on that you will calculate 20% tax also. Either on 13 lakh you pay 12.5% or on long-term gain after indexation calculate 20%, pay that tax. Pay the tax whichever is more beneficial to you. Will you be able to do it? So write down. I am dictating something. Please. In the above question, you have solved this, no? You have solved this question, no? Now write down. In the above question, what would be your answer? What would be your answer if damage or destruction took place on 15th December 2024 instead of 15th December 2019? Damage destruction took place on 15th December 2024 instead of 15th December 2019. Full stop. Insurance claim in this case received on 12th February 2025 instead of insurance claim received on 12th February 2025 instead of 12th August 2024. So I am changing these two dates for you guys. Yes or no? Full stop. Also compute the amount of tax on this gain. What will you do? Same calculation. This is your homework for today. No, don't do it homework. I'll solve with you. Don't worry. Okay. What will you do? First of all, computation of capital gain. Okay. Write down. Computation of capital gain. Same thing I'll do. Copy paste. Right now I will keep these things blank. Okay. Keep these things blank. Now pay attention. Everything will remain same. Every damn single thing remains same. What I will do? I will write down ICOA. I will cancel I. Cancel I. So instead of 12,04,167 and 1,09,470, what will come here? 10 lakhs, and here it will be 1 lakh. Okay. Now the capital gain will be 13 lakhs. Now this 13 lakh of capital gains will be taxable in which year? Same. 24-25. Assessment year 25-26. Why, sir? Because the amount of insurance claim was received in same year. Note 2, Note 1. Note 1 will be for long term gain. No need to make it again. It is already done. Note 1 remains same. Hello, sir. So write down Note 1 same as above. It will not change. Okay. Note 1 same as above, but you will change the date of transfer only. So instead of 15th of December 2019, what you are going to write? 15th of December 2024. That's it. Here only this will change. No, friends. This date of transfer will change. That's it. Everything remains same. Okay. Next one. Note number 2. Note number 2. Same as above. But in note number 2, no. Now we will write some more thing. No indexation to cost of acquisition is allowed since immovable property, that is capital asset, was damaged or destroyed, that is transferred on 15th of December 2024, that is on or after 23rd July 2024. Done, sir? Note number 3. What will you do? Same as above. And the same thing which you have written here, you will copy paste here also. No indexation to cost of improvement, COI, is allowed. So that is the reason we have reduced 10 lakh and 1 lakh. You can write down, combine these two notes into one also, so as to save your time. Okay. So cost of acquisition, cost of improvement, both are not indexed because the asset was damaged or destroyed on 15th of December 2024. Damaged or destroyed, in the bracket you will write transferred. Okay, no? That is on or after 23rd July 2024. Sure? Now this entire capital gain of 13 lakhs will be taxable in the year 24-25 because in the year 24-25 only, you are receiving what, sir? You are receiving the amount of insurance claim. So the year in which you are receiving insurance claim, in that year this will be taxable. Year of receipt. Unfortunately, both are same in this case. And last question we saw that they were different. So damage or destruction, year of transfer is different. But in that year the capital gain is not taxable. Capital gain is taxable in the year in which the insurance claim is received. Sure, sir? One more question we are going to do. Okay, come. Come to test your knowledge. Test your knowledge. In test your knowledge, come to question number 4. Mr. A is an individual carrying on a business. His stock and machinery in the business were damaged and destroyed in a fire accident which occurred in December 2024. The value of stock lost, total damage, was 6,50,000. Certain portion of the machinery could be salvaged. Even the machinery got damaged or destroyed, but certain portion could be salvaged. Okay. The opening balance of the block of that machinery as on 1st April 2024, that is WDV of the last year minus depreciation of the last year, closing WDV of last year becomes opening in this year. Okay, no, is 10 lakh 80. Done, sir. Now, during the process of safeguarding machinery and the firefighting operations, Mr. A lost his gold chain also and a diamond ring, meaning jewelry is also lost in the firefighting accidents. Okay, which he had purchased in April 2005 for 1 lakh 20. So this is the date of acquisition of jewelry and purchase cost of jewelry, actual cost of jewelry. The market value of these two items as on the date of fire accident was 1 lakh 80. Both taken together, the market value as on the fire accident date was 1 lakh 80. Now in this year, these assets are going damaged or destroyed due to fire. Hello. So whenever these assets will be damaged or destroyed due to fire, now fortunately you have taken the insurance for all these assets. So the insurance company is giving you, in this year only, you are getting the claim of rupees 4 lakh 80 towards that stock which is lost. 6 lakh rupees you are getting for the machinery and 1 lakh 80 you are getting for the jewelry. Fortunately, for jewelry, the insurance claim received and the fair market value is same. Can you see? Fortunately, this is same. If I would have been there, no, I would have given 1 lakh 80 over here and I would have given 1 lakh 50 over here. Then you would have been in a trouble. Right now also you are in trouble. What to do, you are not understanding only. See the required part. You are requested to briefly comment on the tax treatment. That's it. What will be the tax treatment from all these things? You are supposed to become a chartered accountant and think. You are a chartered accountant, your client is coming to you, client is giving you this information. What suggestion you will give to your client? Forget about suggestion. You should know for your client what will happen for these amounts. If you will not know, then who will know? A doctor. You are a chartered accountant as a CA. You should know that tax treatments. Come on. So, please pay attention. Wait. Damage or destruction of what? First item, stock. Okay, stock. What was the value of this stock? Come on, tell me. 6,50,000. Now the 6,50,000 is a loss happening in your business. The stock of the business amounting to 6,50,000 going lost by fire. Is it a profit happening in the business or a loss happening in the business? So can I say this is a loss incurred in the course of business or profession? So the 6,50,000 is equal to loss in the course of business. And for this 6,50,000, no, you will get the deduction under the head PGBP. The deduction will be allowed because without adjusting this loss, your profit cannot be calculated. Under which section the deduction will be given? No section, common sense. I've told you. Hello, sir. So under the PGBP head, you will claim the deduction for this 6,50,000 loss. But the loss against which, the loss which was already allowed as a deduction, against which any benefit is happening, that benefit will be as per 41(1) deemed PGBP income. Do you remember? So this loss which was allowed, against this loss only you are getting that insurance claim. Benefit, no. So that insurance claim which you are receiving against this loss is a benefit happening against a loss for which you are claiming deduction. Hello, sir. So that 480 for that stock, 480 is equal to insurance claim. 480 insurance claim against the above stock. So this 480 will now be what? Deemed PGBP income under section 41(1). You don't know such treatments? I haven't taught you. PGBP head, if you remember, this is entire PGBP because business stock going loss for business claimed as a deduction. Against that, whatever benefit you are getting, deem PGBP. The same example also I gave while teaching you 41(1). But I did not tell you the amounts that time. If you remember those things, no, definitely you will be able to answer these things. Now, second thing was machinery of the business. The machinery which was depreciable asset of the business. Even that machinery lost by fire. So machinery is lost during this year. Machinery is lost during this year. Meaning that there was some opening WDV of the machinery. Tell me yes or no. There was some opening WDV. As on 1st of April 2024. What was the opening? 10,80,000. Now tell me, the machinery which is lost by fire, damaged or destroyed by fire, that machinery would be from this machine only, no? Because there is no addition happening in this block in this year. Is there any addition for 180 days or more, less than 180 days? So there is no addition. So if I'll write add additions during previous year 24-25. So there are no additions per se. So your block should have some machine in the end whose value should have been 10,80,000. On that you would have claimed depreciation. But what happened? This year, out of the machinery which should have been there in your block, damaged or destroyed, asset is going out of the block. Hello, asset is going out of the block. Can it be sold and going out? Yes. Can it be compulsorily acquired and go out? Yes. Can it be damaged and destroyed and go out? Yes. So whenever the asset from the block is going out, from the business it is going out, it is to be going out of the block only, no? It is a deletion, my dear friends. So some machine which is damaged or destroyed is nothing but deletion. So what I will do, I will reduce deletion during previous year 24-25. This is damage or destruction. Now tell me, on damage or destruction, meaning on this deletion, whatever amount you will receive, can I say you are recovering that cost only? The cost of the block you are recovering, deletion, yes or no? So how much amount you have recovered? You have recovered 4 lakh, 4 lakh 80 or 4 lakh? How much you have recovered? 6 lakhs. Oh, 6 lakhs. So the recovery is 6 lakhs. See, whenever we create a block, no, additions happens in the block, deletion happens when the assets are sold, deletion happening. Assets are compulsorily acquired, deletion happening. Asset is scrapped, deletion happening. And even the damage or destruction, deletion happening, no? So against this deletion, are you getting anything? Yes. Insurance claim you are receiving, no? So to the extent of 10 lakh, to the extent of 6 lakh, out of 1080, 6 lakh you have recovered. Forget depreciation on this 6 lakh. Now you can claim depreciation on 4 lakh 80 only. Hello? Because out of 10 lakh 80, some machine gone, and against that you are recovering 6 lakhs. So if you are recovering 6 lakhs, meaning that 4 lakh 80 still remains. Now see, to represent this 480, there has to be some machine in the block in the end. Is there any machine in the block? They are saying that some portion of the machine was salvaged. That does not mean that is salvaged is still there in the business and getting used. Are they telling you? No. So there can be two interpretation of this. Some portion of the machinery can be salvaged, means it is still in the business and used. Or can be salvaged, it was salvaged but not usable, insurance company took away. There can be two interpretations. The best interpretation, I tell you, salvage machine still in the block and used in the business. If this is not mentioned, no. So we will assume that the salvage machinery was not, salvage portion of machinery was not usable only. And it was taken away by the insurance company. Hello. So loss assessor came and they took away the salvage machinery and they gave what? The insurance claim of 6 lakh. Now there is no machine left in the block, but still there is value remaining in the block. Can you see the value remaining in the block? How much? 480. So to represent this 480, is there any machinery in the block? No. So if there is no machinery, machine should be there, value should be there, only then the depreciation will come. Value is there, but the salvage machine is not there in the block. Because if nothing is mentioned, I will assume that the salvage machine is not used in the business. It was not usable. Getting my point? Hello? If this was the only machine in the block, it caught fire. 4 or 5 buttons could be salvaged. Portion of the machinery can be salvaged. Now tell me, will it be usable? Portion salvaged. Can it be used in the business? 4 or 5 buttons were saved. Definitely, if not saying anything, that means whatever portion which was remaining was not usable in the business. So the insurance company took away the salvage part, or it got scrapped. I threw it away. I don't have any machine in the block left now. So no machine left in the block, but the value remaining in the block, meaning that depreciation cannot be calculated. Depreciation under section 32 cannot be calculated now. Now what I will have to do? Come on, tell me. If I cannot calculate depreciation, that means this entire value remaining will now be treated as my short-term capital loss under section 5050. And I will write down it is assumed that salvaged portion of machine is not usable and discarded or taken away by insurance company. If I am taking this assumption, hence I am taking this no asset remaining in the block. If I would have assumed that the salvage machinery is usable, that means at the end of the year machine is there, value is also there, then I would have calculated the depreciation also. Getting my point, Mr. Kaushik? Did you understand? Sure. Perfect. So this was the second asset, machinery. Okay. Now come to the third asset. What was the third asset? Jewelry. Gold chain and diamond ring. Can I say jewelry? Now for this also damaged or destroyed. Meaning lost in firefighting operations. So friends, damaged, destroyed, lost means transferred, and this asset means capital asset. Now your capital asset is damaged, destroyed. Here on this transfer, insurance claim is equal to 1,80,000, which is received. Yes or no? And on receipt of this insurance claim, section 45 1A capital gain would arise. And now 45 1A capital gain will be calculated. So to calculate this capital gain, full value of consideration, what will you take? FVC, insurance claim under section 45 1A will be taken as full value of consideration, 1,80,000. Less transfer expense, no transfer expense involved. Net consideration will be 1,80,000 minus cost of acquisition or index cost, depends on the period of holding. So the jewelry, the period of holding of the jewelry I will take now. Period of holding will be from April 2005 or 2008, 2005 to December 2024. So it was acquired and it was lost. This is the period of holding, which is greater than 24 months. Sir, jewelry we used to check 36 months. If the transfer, if the damage would have taken place prior to 23rd July, we would have checked 36 months. But the transfer is taking place, damage or destruction is taking place on or after 23rd July. Hence, we are taking 24 months. Yes or no? Therefore, long-term capital asset. And if it is a long-term capital asset, long-term capital gain will be calculated. To calculate the long-term capital gain, index cost of acquisition is usually reduced, but no indexation benefit will be available. Why? Why no indexation? Since damage, since lost on December 24, that is on or after 23rd July 24. So that is the reason why we are not taking indexation. Yes or no? So what will be the cost of acquisition? The cost of acquisition was 1,20,000 only, no? that will be reduced without any indexation benefit. So the balance 60,000 will now be taxable long-term capital gain. And this long-term capital gain is computed under section 45 1A. Will be taxable in which previous year? Previous year 24-25. This year. Why? Because the insurance claim is received in this year. See, this is the way in which I have presented the answer. I have discussed the tax implications only, but in such a way, that it appears very, interesting to see. Now, if you'll see read the answers given over there, go and read it once. You'll come to know. It's a completely paragraph form, half of which you will not understand only what they have written. But ultimately, whatever written there, we have done that thing only. Understanding? So today at home, you will read that answer once. That's it. Entire thing is covered. They have not bloody calculated the capital gain also. We have calculated the capital gain also. This one. Okay. So this is the end of section 45(1)(a). First specific charge and the questions relating to this. I hope you understood. Sure? Now we will go to the second specific charge, 45(2). Okay? Good. So, we will start with section 45(2) now. 45 subsection 2. Another specific charge. See, in the specific charge, there are profits or gain arising because of some or the other specific reasons. Profit or gain is not arising on normal transfer of capital asset. If the transfer is happening normally for capital asset, 45(1) is enough, to charge that gain. But here, 45(1)(a), specific thing happened, and as a result of that, profit or gain arising. So that cannot be taxed under the head capital gain by applying general charge. So likewise, there will be something which is special, which will happen here also, which will result into profit or gain. But that profit or gain cannot be charged by applying general charging section. So there has to be some specific charge for this type of profit or gain also. We want to charge this gain also under the head capital gains. So what they are telling under section 45(2), they are saying that if any profit or gain which is arising on conversion of a capital asset into stock in trade, meaning that you had a capital asset and now that capital asset you are converting into stock in trade of your business. So any gain arising at the time of that conversion, any gain which arising at the time of that conversion, that gain will also be, that profit or gain will also be taxable under this head. But it will not be taxable in the year in which the conversion took place, transfer took place. No, in the year in which that converted stock in trade will be sold, because that is the year in which this gain will realize. So first of all, you have a capital asset. That capital asset is now converted into stock in trade of your business. So on conversion, whatever gain will happen, even that gain we are going to charge under this head only. Even we will consider that gain as a capital gain. But we will not charge in the year of conversion, in the year of transfer. Rather, we will charge that in the year in which the converted stock in trade is sold. Getting my point? Taxability will be there in the previous year in which the stock in trade is sold and not in the year of conversion. Do you remember the definition of transfer? The term transfer includes sale, exchange, relinquishment of capital asset, extinguishment of right in a capital asset, Compulsory acquisition of a capital asset under any law is also a transfer. And after that, fourth transfer was conversion of capital asset into stock in trade is also treated as transfer. Why it is treated as transfer? Because on conversion, whatever gain happens, that gain we want to charge under the capital gain. For that, we need to make that conversion as your transfer first. So first the conversion is treated as transfer, and on that conversion whatever gain is happening, that is not a normal gain happening on normal transfer of a capital asset. For that 45(1) cannot be used. So to charge that gain under the head capital gain only, we had to make this section 45(2), which is a specific charge. According to this section, this type of specific gain, this type of specific profit will also be taxable under the head capital gains only. We want to charge this gain here only. Getting my point? Now what will happen here? See, I'll have to make one example in front of you. Only then you will understand that what all things are happening and why this conversion treated as transfer. How on conversion I will get the gain? Yes or no? So first of all, let's take this example. Okay. See, this is the example in front of you. This is nothing but a question only. Okay. I have taken the amounts, I have taken the details from that question. So a question will be asked. In that question, these details will be given. Okay. First of all, I have some shares. Example. Here any capital asset can be there. Instead of shares, it can be jewelry also. Instead of shares, it can be immobile property also. Any type of capital asset you are having. Yes or no? So you had some money, 1 lakh rupees, which you invested in shares, thinking that your 1 lakh will grow. Okay. So you are not in the business of buying and selling of shares. You are investing in shares 1 lakh rupees, thinking that the value of 1 lakh will grow over a period of time. So you are buying shares as your investment. You are buying shares as your capital asset. And when you did it, 12th of November 2014. Sorry, 12th of November 2017. Meaning in the year 17-18, you bought your capital asset, shares. At what cost? 1 lakh rupees. Now what is happening? The moment you bought your shares now, they were lying with you. They were lying with you as your investment. So 1 lakh which you have invested now, slowly and gradually the value of the shares was increasing. The 1 lakh rupees invested by you, even that was gradually increasing. So on 11th of December 2020, meaning previous year 2021, on 11th December 2020, the fair market value as on this date was 1 lakh 50. So can I say your 1 lakh of investment is now worth 1 lakh 50 today? So there is an appreciation in the value of your capital asset by how much? 50,000 is an appreciation in the value of your capital asset. Yes or no? Hello sir. What if you go in the market today and sell this capital asset for 1 lakh 50? Will there be 50,000 rupees of gain? Chargeable under which head? Capital gain only, no? Sure. But what is happening? That on 11th of December 2020, you are not going in the market, not selling the shares as your capital asset. Rather, on 11th of December 2020, you started a share trading business. In your share trading business, you started treating this shares as your stock in trade. Meaning that on 11th December, you started one business. In that business, you wanted to bring capital. So, you brought a capital of rupees 5 lakhs. But that 5 lakh rupees of capital you brought in two forms. One, 3 lakh 50 in the form of cash, and this 1 lakh 50 worth of shares as on this day you brought in the business. So what entry you passed on that day? On that day you passed an entry, cash bank account debit in your business. Cash bank account debit 3 lakh 50. Shares, the value of these shares is what? 1 lakh 50. 1 lakh 50 to capital account 5 lakhs. And in your business, now capital is how much? 350 plus 150 of shares which you are bringing in this business as a capital. Now you will be treating that shares as what? Your stock in trade in the business. And wait. If these shares you would have gone in the market and bought today as your stock in trade, you would have spent 1,50,000 to buy your stock in trade today. If you start your business today, so today to start your business, in your business you wanted stock in trade, no? Share trading business you are starting. So in your share trading business, shares will be your stock in trade. So when you are going in the market today, buying your shares as a stock in trade, what will be the cost of these stock in trade? What will be the cost of these shares right now? 1,50,000 only. So in your business, you are buying what? Example, you are buying shares, 1,50,000. So instead of buying it from outside, why not to use the shares which are available with me? Why not to convert them in my business as my stock in trade? Getting my point? So you took these assets out of your investment and you took it in your business as your stock in trade. Now, the date on which these shares becomes your stock in trade. Now they stop being your capital asset. Now they are no more your capital asset. You were holding them as a capital asset from 12th of November to 11th of December 2020 only. This is the period for which you were holding them as your capital asset. The moment you converted them into stock in trade, now they are no more your capital asset. Now they are your stock in trade of the business. Now they will be sold from your business as your stock in trade of the business. Yes or no? When did you bring them in your business? 11th December 2020. You bring them in your business. At that day, what was the value of these shares? 1,50,000. So can I say in your business when the shares came, at that time the value of these shares was 1,50,000. Now your stock in trade in the business is worth 1,50,000. Now the value of this stock in trade is growing slowly and gradually. And now you are selling the same shares from your business as your stock in trade for how much? 1,75,000. So can I say for the time when you were holding them as your stock in trade, the appreciation in the value was 25,000. This appreciation is not the appreciation in the value of capital asset. This is the appreciation in the value of your stock in trade. Getting my point? Hello everyone. Now tell me, if you will sell the stock in trade, when are you selling them? 8th of July 2024. Can you see this date? Prior to. No need to check this date because this is the date of sale of stock in trade. Capital asset already transferred. Conversion. Please check. Conversion. So for capital asset, you have to see this date. What is the date of transfer? What is the date of conversion? But this is not the date of sale of capital asset. This is the date of sale of your stock in trade. When are you selling your stock in trade? 24-25, 8th July. What rate? 175. Now what happened? Now what happened? I will tell you. In the previous year 24-25, in the previous year 24-25, your assessing officer told you that today you are selling what? Sale of shares. You are selling the shares, which is your stock in trade of the business. So AO is saying that you are selling the shares from your business as your stock in trade. When you will sell the shares as a stock in trade, PGBP income will be calculated. What income will be calculated? PGBP income. Because stock in trade is not your capital asset. Stock in trade is is excluded from the definition of capital asset. Yes or no? So if you are selling stock in trade, capital gain will not arise, PGBP income will arise because this is not your capital asset. So PGBP calculation will be done. For that you are supposed to take selling price of these shares. What was the selling price? 1,75,000. And from that you will reduce the cost of the shares. For how much you acquired the shares? You acquired these shares long back for rupees 1 lakh. Yes or no? So the cost at which you acquired the asset was 1 lakh. Cost at which you acquired the shares was 1 lakh, and that same shares you are selling in the form of stock in trade. For rupees 1,75,000. So the entire 75,000 rupees gain happening over and above the cost will be treated as your PGBP income because you are selling them as what? Stock in trade. Getting my point? This is what your assessing officer was telling you. Hello, sir. But you were not happy. Why you were not happy? Because assessing officer is treating 75,000 as your PGBP income, normal income, taxable at normal rates. In this 75,000, he has included the gain arising, appreciation happening in the value of capital asset also included in this 75,000. If you would have sold the assets in the form of capital asset, that 50,000 would have been taxed under the head capital gains. Now that 50,000 also got included here. Come, see. If you would not have converted, you would have sold it, then that 50,000 would have been taxed under the head capital gains. That 50,000 was the appreciation happening in the period for which I was holding the same shares as my capital asset. That should have been taxed to me under the head capital gains. And if you are reducing 1 lakh rupees as my cost here, what is happening, 75,000 gain is coming. That 75,000 includes the gain for the period for which I was holding the same shares as capital asset, and this includes the gain for the period for which I was holding the asset same shares as my stock in trade. I am ready to pay tax on the gain which is happening during the period for which I am holding them as stock in trade under PGBP, but I am not ready to pay tax on the gain happening at the time when I was holding the same shares as what? Capital asset. I am not ready to pay tax on that gain under the head PGBP. So now what the assessee is saying? AO is saying that this should happen. AO is saying that this should happen. Yes or no, friends? Are you understanding what is happening? And now what the assessing officer is saying? Now what the assessee is saying? Assessee is saying that, see, I am selling the shares. Sale of shares, and my sale of shares is happening as stock in trade. So I don't mind calculating PGBP income. I don't mind calculating PGBP income. I will calculate PGBP income and I will pay tax on the PGBP income. But the selling price will be 1,75,000 for my stock in trade, which I accept because I am selling the shares for 1,75,000. So my selling price of the stock in trade is 175. What I want to say here, that instead of reducing 1 lakh rupees as cost, if 1 lakh rupees cost is reduced, what is happening? The gain for the period for which the capital asset was held as what? Capital asset, even that gain gets taxed under the head PGBP. How can you bloody charge the appreciation in the value of capital asset under the head PGBP? Which law is giving you that right to do that thing? Appreciation in the value of capital asset has to be taxed under the head capital gains. Only the appreciation in the value of stock in trade which I am realizing by selling the stock in trade should be taxed here. So to do that, 1 lakh rupees cost reduced from here is wrong. I should be taking the stock in trade cost as 1,50,000 and not 1 lakh. 1,50,000 I will take as the cost of my stock in trade, so that my capital gain does not get taxed here. I am taxed only for the profit and gain of my stock in trade. Only 25,000 should be taxed here. Getting my point? This is what assessee says. Meaning that the extra 50,000 gain which relates to what? Period of holding of capital asset shall be taxed under the head capital gain, shall be taxed under the head capital gain and not under the head PGBP. Yes or no? Tell me, whose argument is logical? Assessee only, no? But the assessing officer was not accepting this. And assessee was saying one more thing, this 50,000 of extra gain cannot be taxed under PGBP. It has to be taxed under the head capital gain. But unfortunately, profit and gain arising on transfer of capital asset only is taxable under the head capital gain, and since no transfer is done by me because asset still remains with me, this 50,000 cannot be taxed under capital gain also. This is what assessee was saying, and that is what assessing officer was uncomfortable with. Assessing officer was thinking that if I don't charge this entire 75,000 under PGBP, no, what will happen? Only 25,000 will be charged under the head PGBP, and remaining 50,000, which relates to the period of holding for which the asset was held as what? Capital asset, should be taxed as capital gain. Even I know. But I cannot do it because there is no transfer of capital asset taking place. Assessee himself is keeping that asset. Earlier he used to call the asset as what? Capital asset. Now he is calling that asset as stock in trade. There are no two parties involved, no consideration involved. So this is not a transfer only. And if there is no transfer, without transfer, how the capital gain will arise, and how this capital appreciation will be taxed under the capital gains? Because general charge is there which says that any profit or gain arising on transfer of a capital asset will only be charged here. There is no transfer taking place, so I'll not be able to charge this gain under the head capital gain. So it is better for me to give all such bullshit arguments and charge under the head what? PGBP. And what he was saying, see, the total gain happening is what? 75. And that total gain is happening at the time of sale of stock in trade. So this is the gain happening on sale of stock in trade, should be taxed under the head PGBP only. That is what he was saying. But the assessee was giving a detailed and logical argument for that. That I don't want to pay tax on this 50,000 under the head PGBP. I am not saying that I don't want to pay tax on the balance 50. I want to pay. But how would I pay under the head capital gains if your capital gain head only does not want to charge tax on this? Your capital gain head says that any profit or gain arising on transfer of capital asset will be charged under the PGBP, and I have not done the transfer. So till the time I have not done the transfer of this capital asset to someone else for consideration, how will I charge this 50,000 under the head capital gains also? That does not give you a right to charge this under the head PGBP. This case went till Supreme Court. Name of the case was This was the name of the case. By Shirin Bai K. Kuka. And in this case, the argument placed by the assessee was accepted by the Supreme Court, and Supreme Court also gave the same judgment, that in the absence of any specific provisions under the capital gain head, this gain cannot be taxed under the head capital gain because there is no transfer involved. Getting my point? And realizing this gain at the time of sale of stock in trade does not allow the department to charge this gain under the head PGBP, because this is not the gain which should be taxed under the PGBP head. This was the gain, this was the appreciation happening in the course, in the period during which the asset was held as capital asset. This should have been taxed under the head capital gain, but your capital gain head is silent regarding the taxability of such type of gains. Meaning your government only, lawmakers only does not want to charge this under capital gain head. Otherwise there would have been a provision. And in the absence of any specific provision, this gain cannot be taxed under the head capital gain by taking general charge as an option, because general charge will not come here. There is no transfer of the capital asset. Hence, the assessee is not liable to pay tax on the entire 75,000. He is liable to pay tax only on 25,000 under the head PGBP, and the balance 50,000 gain, which relates to the period for which the capital asset was held, that will not be taxed at all. Forget about PGBP. It will not be taxed under the head capital gain also, because there is no transfer and there is no specific provision requiring the assessee to pay tax on this gain under the head capital gains. Assessee won the case. See, whenever there is a Supreme Court judgment, whenever this judgment passed, next day in the morning, all the leading newspapers across the country will print the Supreme Court judgment on the first page of the newspaper. You can see. Have you seen newspapers ever in your life? We are a generation doing in shorts right now. Small news done. We don't read any news in detail because we are impatient people. Right now what? We'll see the headline and in short, what is the news? That's it. In short. Scrolling and news is done. Earlier, 10 years back also, the newspapers were very relevant to get the news. Okay. So whenever the newspaper is there, Telegraph, then Times of India, then Economic Times, many newspapers are there. In Tamil also, in Gujarati also, in different language. All the leading newspapers they will print this Supreme Court judgment on the front page, because this will now become the law of land. So everyone around the country should know about this. There is a requirement that Supreme Court judgment has to be printed on the first page, front page, because now this will become the law. Now, when the judgment came, people like us, talk about myself only. In the morning, I was, taking my tea, I was drinking my tea, and I opened the newspaper. Front page only, I saw this judgment. What this judgment was saying? If the capital asset is converted into stock in trade, and now that is sold as what? Stock in trade, the total gain arising in this transaction will not be taxed under the head PGBP. Only the gain which relates to the period for which the asset is held as stock in trade will be charged under the head PGBP. The gain which relates to the period for which the asset was held as capital asset cannot be taxed under the head PGBP, and it can neither be charged under the head capital gains. Why? Because there is no transfer. Hello. And there are no specific provisions under the capital gain head requiring the assessee to pay tax under capital gains on such appreciation, on such gain. Hence, that gain will not be taxable at all, not even under PGBP. Forget about PGBP, not even under capital gains also. This judgment came in the newspaper. Early morning I am reading this. Now what I will think, What I will think? I have purchased some jewelry 20 years back for 1 lakh. Right now the value of that jewelry is 25 lakhs. Appreciation in the value of capital asset is 24 lakhs. I want to sell the jewelry. But if I sell the jewelry as capital asset, what will happen? 24 lakh will be taxable under capital gains. The moment I saw this case law, automatically an idea came. From today I will start my jewelry business. And I will become a jeweler. And I will convert this jewelry into my stock in trade of my jewelry business. And after some time, I will sell this jewelry for 27 lakhs. How much I bought it for? 1 lakh. What was the fair market value as on the date of conversion? 25 lakhs. So total 24 lakh rupees of appreciation in the value of capital asset has taken place. Now, when the value was 25 lakhs, I brought it into my business. I started a jewelry business. And in my jewelry business, I started using the jewelry as my stock in trade. Now after some time, the same jewelry which was 25 lakhs, it became 27 lakh as my stock in trade, I sold it. How much total gain happening? 1 lakh to 27 lakh, total 26 lakh gain. Out of that, majority of the gain will be for capital gain period, capital asset period. That will not be taxed at all. Supreme Court judgment. Only 2 lakh rupees of gain. 25 to 27 will be taxed under the head PGBP. Entire 24 lakh will go out of the income tax net. Getting my point what I am trying to tell you? Meaning that now because of this judgment, which was very logical, now a loophole in the law came to be known that, my God, if nothing is done to plug this out, every assessee who is holding a capital asset, maximum appreciation has taken place. Now convert all their capital asset into stock in trade. And now everyone will start selling their capital asset in the form of what? Stock in trade. So that the majority of the gain arising in the period of capital asset gets out of the income tax net. And they are going to pay tax only on a very small amount of appreciation happening during the period of holding of the stock in trade. So something needs to be done. Otherwise, there will be a revenue loss to the government. And nobody will sell their capital asset in the form of capital asset. Now everyone will convert their capital asset into stock in trade and sell the capital asset in the form of stock in trade. And whenever we will try to charge tax on the entire gain, they will show this judgment and say we will not pay tax on the entire gain because the gain which relates to the period of holding of the capital asset cannot be taxed. I have not done the transfer. And there is no specific provision under the Income Tax Act, under the capital gain provision, requiring me to pay tax on this gain under the capital gain side. So I will pay tax only on the remaining gain which was for the period of holding of the stock in trade. Loophole, no? So to nullify the effect of this judgment, what did I say? To nullify the effect of this judgment, the government had to amend the definition of transfer. Immediately one point inserted that from today onwards, any conversion of capital asset, even though it is not a transfer, but for the purpose of capital gain head, it will be treated as a transfer. Now the law makes it a transfer, so it will be a transfer. Now any gain arising on this transfer is not a normal type of transfer, yes or no? Any gain arising on this transfer cannot be charged under general charge. We'll have to take a new charge for this. So 45(2) came into existence, and under section 45(2) what they said, that now this gain arising on conversion of capital asset into stock in trade, gain arising at the time of conversion, will also be charged under the head capital gains. But it will not be charged in the year of conversion, in the year of transfer. Rather, it will be charged when it is realized. When it will be realized? When the stock in trade will be sold. That time only the gain for the capital asset period of holding and the gain for the period of holding of the stock in trade, the entire gain will be realized at that time only, no? When the stock in trade will be sold. At that time, both the gain will be taxable. The gain for the period of holding of the capital asset also and the gain for the period of holding of the stock in trade also, the entire gain will be taxed at the time when the stock in trade is sold. So now there will be two statements. Now the entire gain will not be taxed under the same head, PGBP. Now there will be two statements made. One statement for PGBP and another statement for capital gains, 45(2). In the PGBP, the gain for the period for which the asset was held as stock in trade, only that gain will be taxable, and under the capital gain statement 45(2), the gain for the period for which the asset was held as capital asset, that gain will be taxable under the capital gain head. That way we will be able to charge tax on the entire gain, not under the same head but two heads separately. But the taxability will be done in the year in which the stock in trade is sold. Till the time the stock in trade is not sold, till that time the capital gain will not arise, until the time the PGBP will not arise. But the moment stock in trade is sold, both the gain will arise and both the gains will be taxable also. Will you remember this? Sure. So in the given question, the question which we had, now we are supposed to calculate the capital gain. Wait, pay attention. See, capital asset, conversion is a transfer. So this gain, 50,000 will be taxed under the head capital gains now, 45.2. And from here till here, you are holding the stock in trade. So this gain will now be taxable under the head PGBP. But both the gain will be taxable in the year in which the stock in trade is sold. Will you remember this? Sure. So based on this, should I start solving the question now? This is the question. Should I start the solution? Come on, tell me. I will be in which year? Previous year? 24-25. Assessment year? 25-26. What is happening in this year? Come on, tell me. Look at the question and tell me what is happening in 24-25. Stock in trade is sold now? Yes. So that is the year in which I will make two statements now. So this is the year of sale of what? Stock in trade. This is the year in which the stock in trade is sold. So when stock in trade is sold, PGBP statement will be prepared. And in this year, 45.2 specific charge will also arise, and that capital gain will also be taxed in this year. So, one, I will calculate the PGBP income, and two, I will calculate capital gain under section 45.2, because this gain will be charged to tax in the year in which the stock in trade is sold and not in the year of conversion. Yes or no, friends? So tell me, first we'll calculate PGBP income, okay? So look at the question again. I am selling my stock in trade in 24-25 for how much? 1,75,000. Hello? And gain is 75. Total gain is 75. But how much should be taxed under PGBP? Only 25, no? 25 will be taxed under PGBP only if the cost is taken 1,50,000. So this 1,50,000, which is a fair market value as on the date of conversion, this will be deemed to be the cost of my stock in trade to calculate my PGBP income. This is as per the Supreme Court judgment. Cost of the capital asset cannot be taken to calculate PGBP income. Cost of the stock in trade will be taken, and stock in trade cost will be nothing but the fair market value as on the date of conversion. So this gain should be taxed under PGBP head. Yes or no? So this gain will be taxed only if from this cost will be reduced 1,50,000, and which is nothing but the fair market value as on the date of conversion. Will you remember this? So tell me, PGBP income, I will calculate selling price of my stock in trade, which is how much? 1,75,000. Minus cost of stock in trade. And cost of stock in trade will be fair market value as on date of conversion. Wherever, whenever 45.2 will be there, to calculate PGBP income, I will have to take this fair market value only as what? My cost of stock in trade. Okay. So what was that? 1,50,000 only, no? So I will reduce 1,50,000. So how much I will get? I will get 25,000 as what? As my PGBP taxable income. This will be taxable under the head PGBP and in the year 24-25. PGBP calculation difficult or easy? Easy, no? Now pay attention. Come to the question. Look at the question. See, everyone. This minus this. So this gain will be taxable under PGBP. So can I say this minus this? So this will be taxable under capital gain. The fair market value which you have taken as cost for PGBP, no? Now that fair market value will be deemed to be your full value of consideration to calculate your capital gain. That same fair market value, from that you will reduce the cost of 1 lakh, you will get 50,000 of profit. No. So that 50,000 profit should be taxed under the capital gain. So to charge 50,000 under capital gain, what should be the fair market, what should be the full value of consideration? This same 1 lakh 50 should be the full value of consideration for capital gain. No. Hello sir. Understood? Sure. To calculate PGBP from selling price, this was your cost. You got 25,000 of profit taxable under PGBP. But now in capital gain you want to charge this 50, no? How you will charge 50,000 in capital gain? Cost is this. Hello? So what should be the FVC? This should be the FVC. Only then 50,000 will be charged under capital gain, no? So what you will do? This 50 you have taken here, no? This same 50, the FMV as on the date of conversion, this same 50 you will take as what? Full value of consideration to calculate your capital gain. Without this, under section 45(2), you have to take this amount only as your full value of consideration and no other amount can be taken. Only this amount you will take to calculate your capital gain under section 45(2). The amount which you used as cost for PGBP will become now your FVC, because on that day, if you did not have converted, you would have gone in the market and sold the capital asset. How much you would have got? This much amount only you would have got, no? So this should be treated as your full value of consideration. Yes or no? So FVC is nothing but fair market value as on date of conversion, which was nothing but 1,50,000. Sure sir. Minus what? Transfer expense. Any conversion related expenses happened? No. If happening, then reduce that as transfer expense. Yes or no? So what will be the net consideration? Net consideration will be 1,50,000. Sure sir. Now out of this, what will you reduce? Cost of acquisition and cost of improvement, if any. Hello sir. But wait. Tell me, cost of acquisition of the capital asset now you have to reduce. And cost of improvement of the capital asset now you have to reduce. Yes or no? So go and check. Shares. Can you see the shares? What was the cost of acquisition? 1 lakh. And if any other asset would have been there, then cost of improvement would also have been incurred. So even that cost of improvement you have to reduce. Yes or no? So let us say that there was no cost of improvement, only the cost of acquisition. Now, will this be indexed or without indexation? Depends on the period of holding. You are supposed to take the period of holding of the capital asset only, not the shares. You are supposed to take the period of holding of the shares as capital asset. From which date you started holding the shares as capital asset? This date only, no? So this is the date on which you are acquiring your capital asset. Hello, this is the date on which you are acquiring the capital asset. And till what date you are holding the capital asset? Till this date only, no? Hello sir. So your period of holding of the capital asset will start from date of its acquisition and it will be taken till the date of conversion, date immediately preceding to date of conversion, because from conversion date it is becoming a stock in trade. So can I say this is the period of holding of your capital asset? Now check only this period of holding. Check only this period of holding and tell me, if the asset is short term, cost of acquisition, cost of improvement will be without indexation. And if this is long term, in our case it is long term, please check. 17-18 to 2021, more than 12 months, more than 24 months, shares are listed or shares are unlisted, more than 12 months, more than 24 months. Yes or no? 36, no 36, yes. Shares are long term. Now tell me, if the long term shares are there, cost will be 1 lakh? Yes. Will it be indexed? Yes. Why? Conversion is the transfer. Transfer taking place prior to 23rd July. Please check. If this conversion date was given on or after 23rd July, then I would not have done indexation. But the conversion date, transfer date is prior to 23rd July. I will have to now do indexation also. Hello, sir. Is the period of holding from this date to this date? Yes. If looking at this, I can say my asset is short term, yes. Then whatever cost of acquisition and cost of improvement is there, no, I will not index without indexation because the asset is short term. But in my case, it is not short term. From here till here, from here till here, if you will check the period of holding of the shares, unlisted shares, period of holding is more than 24 months. Asset is long term. And indexation will also happen because conversion, meaning the transfer happening prior to 23rd July. Check this date. Prior to 23rd July, conversion is taking place. And if the conversion transfer takes place prior to 23rd July, asset is long term, I will have to do the indexation. Cost of acquisition, cost of improvement, both will be indexed. Cost of improvement is not there. Acquisition is there, no? I will index it. So what I will take? Come on, tell me. Less index cost of acquisition. I will take 1 lakh rupees into CII of which year? CII of transfer year. Now you will tell me when the capital asset was transferred. When the capital asset was transferred, date of conversion, capital asset transferred, no? So transfer year is 2021. Transfer year is 2021. What is the CII? 301. Very good. So CII of transfer year will be CII of conversion year. Please don't commit mistake over here. 301 divided by CII of acquisition year 1718 272. So can I say 1 lakh into CII of transfer year 301? Yes. CII of acquisition year 272? Yes. Can you calculate the index cost? 1 lakh into 301 divided by 272. You will get 1,10,662. Did you get 1,10,662? This was your index cost of acquisition. No cost of improvement is there. No need to index. Next one. Minus 1,50,000. So you will get 39,338. Can I say this is long-term capital gain which you computed under section 45(2)? Now this long-term capital gain will be taxable. In which year? In the year in which the stock in trade is sold, meaning 24-25. Even this will be taxable. Everyone understood this much? Hello, sir. Should I move? Because see, there are many questions on this concept. If you will not understand, you will not be able to solve a single question. Did you understand this? Pay attention. 39,338. See, same answer we got. 39,338 taxable amount. So whenever there is a capital asset which is converted into stock in trade, that conversion of capital asset is a transfer as per 247. Any profit or gain arising on this type of transfer will also be taxable under the head capital gain. 45(2) says that even this profit or gain will be taxable under capital gains. But this will not be taxable in the year of conversion, in the year of transfer. Rather, it will be taxable in the year in which the stock in trade is sold. Because this gain will be realized along with the PGBP gain. Yes or no? So both the gain realized at that time, both the gain should be taxable at that time. Okay? To understand, we gave this example. So what all things we did? Tell me. PGBP income we calculated capital gains also. So full value of consideration for capital gain purpose. For capital gain purpose, remember 45(2) capital gain you are calculating. What amount you will take as full value of consideration? The amount which you took as a cost of stock in trade. Fair market value as on the date of conversion. Fair market value as on the date of conversion into stock in trade. That fair market value will be treated as your full value of consideration to calculate your capital gain. From which date to which date you will take the period of holding of your capital asset. The date on which you acquired the capital asset, from that date till the date of conversion, you are going to take the period of holding. Yes or no? And based on this period of holding, if your capital asset is short term, will you do any indexation? No. Cost of acquisition, cost of improvement will not be indexed. But based on this period of holding, if your capital asset is long term, then cost of acquisition, cost of improvement, both will be indexed. If the date of transfer, meaning the date of conversion, was prior to 23rd July, which we did in our case also. If the date of conversion, date of transfer is on or after 23rd July, date of conversion means date of transfer is on or after 23rd July 2024. Then even if the capital asset is long term, cost of acquisition, cost of improvement will not be indexed, because from now onwards the indexation benefit is gone. And if capital asset is long term and the transfer date was prior to 23rd July, will you index the cost of acquisition and cost of improvement? Yes. So how will you index? You will take cost of acquisition multiplied by CII of transfer year. Transfer happened in the year of conversion. So multiplied by the CII of conversion year divided by the CII of acquisition year. How will you index the cost of improvement? You will take the cost of improvement multiplied by CII of transfer year, meaning the CII of which year? Conversion year, because the conversion was the year in which the transfer took place. Hello sir. Divided by improvement year CII. This, by applying this formula, you will be indexing the cost of acquisition and cost of improvement. Hello sir. Everyone understood? Okay. Now this part we are going to do later. We are completely ready to solve all the questions now. Okay, come to the ICI study map. Illustration number 2. Illustration number 2. A is the owner of a car. On 1st of April 2024, he starts a business of purchase and sale of motor cars. He treats the above car as part of his stock in trade of his new business. He sells the same on 31st March 2025 and gets a profit of 1 lakh. Discuss the tax implication in the hands under the head capital gains. No tax implications would arise under the head capital gains. The entire profit of 1 lakh will be taxable under the head PGBP only. Why? Because conversion of capital asset into stock in trade will result capital gain under section 45(2). The asset transferred by him was a car, and if nothing is mentioned, I will assume that the car was a movable personal effect for him, and movable personal effect is not a capital asset. If you convert it into what? Stock. If you would have sold it, would there have been any capital gains? No. Why? Because that is not a capital asset only. So just because converting, there will be capital gain. Conversion of capital asset should happen into stock in trade. When you transfer capital asset, then capital gain arises. So when you convert a capital asset, then only 45(2) will arise, no? The transferred asset is not your capital asset only. Hence, on conversion, 45(2) will not be attracted. No capital gain will be resulting. Entire profit 1 lakh will be taxable under the head PGBP only. Out of this, something under capital gain, something under PGBP, that you are not supposed to do here. Will you remember? Everyone, easy question, difficult question? Easy question. Okay, so this question is done. Question number 2 is done. Come to question number 1 now. Come to question number 1. Illustration number 1. See, illustration number 1 is about period of holding. Illustration number 1 is about period of holding. What will be the period of holding of the shares in the liquidation? See, write down. Discussed under section 46(2). So when I will be discussing 46(2) now, you will get the answer of this. Hello sir. What will be the period of holding of bonus shares? I have not told you. If the bonus shares are listed, the period of holding will start from date of credit in the demat. Hello. And it will end on date of sale. But if the bonus shares are unlisted, their period of holding will start from date of allotment till the date immediately preceding to date of transfer. Hello sir. So bonus shares already known, that you have done with section 55 to AA. Along with that, we have already done. What is a flat in a cooperative society? Do you remember we have done the definition of transfer 247? In 247, last transaction, I made a building, big building, many flats I made. The entire building owned by cooperative society. The entire land on which the building stands is also owned by a cooperative society. So, in that cooperative society, if you are owning a flat, are you the owner of that flat? No, you are not the owner of that flat. You enjoy the right. You have the right to enjoy the flat as an owner, which is because of the membership in that society. Hello, sir. So once you become the member in that society, only then you enjoy the property as an owner, ownership right. Hello, sir. Whenever you transfer that right, get that, whenever you get that membership from the cooperative society, whenever the shares are given by the cooperative society to you, from that day you get the ownership of that flat. Till what time? Till the time you don't transfer it. Getting my point? So these 2 points we already know. What about this? This we are going to do with section 46.2. Okay. After we are done with 46.2, this part will be covered there. So question number 1 also done. Okay. Question number 2 is also done. Very good. Come to question number 3. Good question. X converts his capital asset acquired on 10 June 2006 for 60,000 into stock in trade on 10th March 2024. Wait. One capital asset he acquired. This is the date of acquisition of the capital asset. At what price he acquired? 60,000. Can I say this 60,000 is the cost of acquisition of his capital asset? So date of acquisition of capital asset is known and cost of acquisition of the capital asset is also known. Yes or no? Now this is converting. So date of conversion is also known. When it is converted? 10th March 2024. So this is the date of transfer of his capital asset. Date of acquisition of capital asset given. Date of transfer, meaning date of conversion, is the date of transfer is also given. Okay. Now the fair market value was 5,50,000 as on the date of conversion, meaning on 10th March 2024 the fair market value as on the date of conversion was how much? 5,50,000. He subsequently sells the stock in trade, so converted for 6 lakh on June 10, 2024, meaning that the stock in trade is not sold in 23-24 on 10th March. No. 10th March it got converted into stock in trade. Now that stock in trade is being sold in the previous year 24-25 on 10th of June 2024-25. So can I say in the previous year 24-25, two gains will be calculated. PGBP will also be calculated and capital gain will also be calculated, and both will be taxable in the year 24-25, because 24-25 is the year in which the stock in trade is sold. And the capital gain arising on conversion, whatever will be there under section 45(2) will also be taxable in that same year, in the year in which the stock in trade is sold. Stock in trade is sold, so PGBP will also arise. That will also be taxable in the year in which the stock in trade is sold. That's it. But if it is written here that what will be the amount of those capital gain and PGBP income, then we will have to go one step ahead and we'll have to calculate also. Yes or no? So in your question, write down if also compute the amount of taxable business income and capital gains. Now we are going to calculate that also. Okay. So pay attention. Same thing can you see here? What I'll do? I will remove the unnecessary things. Okay, sir? Okay, sir? Perfect, sir. I am ready with my format. So, I had a capital asset which I converted into stock in trade, and that stock in trade I am selling, right? When did I acquire the capital asset? Come on, tell me. 10 June 2006. 10 June 2006. Converted into stock in trade on 10th March, no? Which? 10th March 2024. 10th March 2024 and sold as stock in trade on 10th June 2024. 10th June 2024. Okay. I acquired for how much? I acquired for 60,000. As on the date of conversion, what was the fair market value? It was 550. 550 was the fair market value. This is the actual cost of capital asset. This is the fair market value, and on 10th June it was sold for 6 lakhs. Can I say 6 lakh was selling price of my stock in trade? Now these figures will be used to calculate. Done, no? So now tell me, stock in trade is sold for how much? 6 lakhs. So to calculate my PGBP, selling price of stock in trade 6 lakhs. Minus cost of acquisition. What cost? Sorry, minus the cost of stock in trade. What was the cost of my stock in trade? The fair market value as on the date of conversion, which was 5,50,000. I will take this only. So only the gain from 550 to 6 lakh will be taxable under PGBP. That's it. Because that is the gain for the period for which I am holding the asset as stock in trade. Okay. Earlier gain for the period for which I was holding the asset as capital asset cannot be taxed under PGBP. That gain will come right hand side. See 45.2. Yes or no? So here I will reduce 5,50,000. So my PGBP income will be how much? 50,000 taxable. This will be taxable in the year in which the stock in trade is sold, 24-25. Done. Now in that year, the year in which the stock in trade is sold, in that year, the capital gain for capital asset under section 45.2 will also be calculated. The fair market value which is there will be treated as full value of consideration for 45.2. So the same amount 5,50,000 I will take here as what? As my full value of consideration. Minus transfer expense, no transfer expense. Net consideration will be 5,50,000. Now I will reduce cost or index cost. Depends on the period of holding of my capital asset. Can you see the capital asset I started holding on 10th June 2006? And I transferred the capital asset on conversion. So can I say this is my period of holding of my capital asset? And period of holding is more than what? 12 months, 24 months, 36 months, as the case may be. Okay, because what type of capital asset is there, they have not given. Have they given you what type of capital asset it is? So I'll not be able to decide that I have to check 12 months, 24 months or 36 months, whatever it is. It is greater than all the period of holding. And why I am checking 12, 24, 36, because the transfer, because the conversion is made prior to 23rd July. Conversion means transfer made prior to 23rd July 2024. So 12, 24, 36, all the period of holding can be checked. Okay. Old period of holdings I have to check. Now, if the period of holding is 12, 24 or 36 or less than that, then the asset is short term, no indexation will happen. Hello. But if the period of holding is more than 12, 24, 36, as the case may be, then the transfer is taking place prior to 23rd July, 10th of March. Hello. Now I will have to index the cost also. So what was the cost of my capital asset? 60,000, no? So I will index that 60,000. Hello, sir. Are you all understanding what is happening? So I will take 60,000 as cost of acquisition of my capital asset into CII of transfer year. In which year the conversion took place? 23-24. March 24 means 23-24. So the year of conversion is the year of transfer. What is the year of transfer? 23-24. What was the CII? 348 if I am not wrong. CII of 23-24 is 348. Okay. Divided by CII of acquisition year. In which year acquisition was made? 6-7. Divide 6-7. What is the CII of 6-7? 122. Now please calculate the index cost. 60,000 into 348 divided by 122 will give me 171,148. 171,148 will be your index cost of acquisition. Fortunately, there is no cost of improvement. If the cost of improvement would have been there, I would have taken that cost of improvement and I would have indexed that also. Hello, sir. So reduce this amount out of 5,50,000. You will get 378,852. 378,852. This will also be taxable in the same year in which the stock in trade is sold, 24-25. In the entire question, if you will see, no, they have not made these calculations. And you were doing. Because it was not asked. Just say when both the incomes will be taxable. That's it. Okay. And when both the incomes are taxable and they're telling you to calculate also, then the calculation will be made like this. Understood, everyone? Should I move ahead? Sure. Come to test your knowledge. Test your knowledge. Question number 2. Arav converts his plot of land, meaning a capital asset, which was purchased in July 24. So this is a capital asset which he purchased in July 2004, meaning this is the date of acquisition, and 80,000 was the actual cost of the capital asset. Into stock in trade on 31st March 2024. Can I say 31st March 2024 is date of conversion? Yes, sir. The fair market value as on that date was 3 lakhs. So this 3 lakh is the fair market value as on the date of conversion. Stock in trade was sold. Stock in trade was sold for 3,25,000 in the month of January 25. So can I say previous year 24-25 the stock in trade is sold? Yes. So in the previous year 24-25 PGBP will also be calculated. Capital gain will also be calculated. Yes or no? Same to same format which I made. Hello sir. Here. What I will do? I will do the favorite thing which I do always. My format is already ready. Everything will change now. Amounts will change only. What everything will change? Only the amounts are changing. No. Rest everything remaining same only. No. Hello sir. So tell me. Capital asset was plot of land. Plot of land. Okay. Now the capital asset is identified. It is a plot of land. The asset was acquired on July 2004 for 80,000. July 2004 for 80,000. Converted into stock in trade 31st March 2024. As on that day, the fair market value was 3 lakhs. And it was sold on January 25, meaning previous year 24-25. For how much? 3,25,000. That's it. Done. So selling price of stock in trade will be 3,25,000. So selling price of stock in trade was 3,25,000. What was the cost? Fair market value as on the date of conversion 3 lakhs, sir. Sir, what is the PGBP? 25,000, sir. So this same fair market value will now be taken as full value of consideration 3 lakh minus transfer expense, nothing. Net consideration is 3 lakhs. Now, cost of acquisition of the capital asset was, how much? 80,000. So 80,000 will be indexed or will not be indexed. Depends on the period of holding. Please check. Capital asset was plot of land. Acquired in July 2004. And it got converted on 31st March 2024. 20 years period of holding. More than 2 years only, no. More than 24 months only, no. For plot of land, the period of holding should be more than 24 months. Is it more than 24 months? Yes. Plot of land is a long-term asset? Yes. And the conversion, transfer is taking place prior to 23rd July. 31st March 2024 is prior to 23rd July only, no? So the cost will be indexed. And here I will take 348 as the year of transfer. Conversion. Year of conversion is 23-24. That is the year of transfer. Divided by year of acquisition. That was July 2004. 45. What is the CI of 45? 109 or 117? 117, no? 105. 109. 117, 122. 45. What is the CII? 45. I will have to take 45 CII, no? Okay, 113. Oh, 113. Now, index 80,000 into 348 divided by 113 will give you 246, 372. 246, 372. If I reduce it out of 3 lakh, I will get 53, 628. 53, 628 will be my capital gain under section 45(2), will be taxable under the head capital gains in the year in which the stock in trade is sold. So the year in which the stock in trade is sold, in that year PGBP will be taxable 25,000 and the capital gain 53, 628 will also be taxable. Easy, no? One more question. Come to illustrations. Illustration number 8. Illustration number 8. Wait. Mr. A converts his capital asset acquired for an amount of 50,000. So capital asset acquired for 50,000 in June 2004. Okay. Into stock in trade in the month of. So converts in the month of November 23. Meaning the conversion is taking place in 23-24. Okay. The fair market value on the date of conversion was 4,50,000. The stock in trade was sold. Stock in trade was sold for an amount of 6,50,000 in the month of September 24. Very easy question. What will be the tax treatment? I will first calculate the PGBP here. PGBP. Selling price of stock in trade. Come on, tell me. 6,50,000. Cost of stock in trade. Fair market value as on the date of conversion. Yes or no? That was 4,50,000. You will not write like this, you will write in the full format. Okay, 2 lakhs. This will be your PGBP income. Now 45(2) capital gains. To calculate the capital gains, do you remember this 450 only will be taken as full value of consideration? So 4,50,000 will be taken as full value of consideration. Minus transfer expense, no transfer expense, sir. No transfer expense. Meaning that 4,50,000 will become your net consideration. Minus cost or index cost depends on the period of holding. So period of holding will start from June 2004 till November 2023. And that period is more than 12, 24, 36 as the case may be. Yes or no? So now the cost will be index. What was the cost? 50,000. So you will take 50,000. Yes, sir. Multiplied by CII of transfer year. What is the year of transfer? 23-24. Conversion year is 23-24. Yes or no? Don't take 363 by mistake. The year in which the asset was converted, that year is November 23, means 23-24. So multiplied by 348. Divided by year of acquisition, that is 45. You will get 113. Okay. So 50,000 into 348 divided by 113 will give you 153. 982. 982. Okay. No improvements. No improvements, sir. So what will be your capital gain? 296,018. 296,018. Tell me, taxable or not taxable? Taxable in the previous year in which the stock in trade is sold. So what year the stock in trade is sold? September 2024, means previous year 24, 25. So this will also be taxed in this year and this will also be taxed in this year. Both will be taxable in the same year. Done? No, same question, only the amounts are getting changed. Okay. So now one question, no, I'm giving you for homework today. One question. And tomorrow the first thing we are going to do that section only. Question only. Okay. Come to your test your knowledge part. Test your knowledge. In that, question number 3, you can see 3, Harshita. But before that, please make sure that read the question only this much, till here. Till here only read the question and solve. No need to read anything given on the next page, because that is to be done when I will be teaching you a new section 54 EC. At that time, the balance part will be done. But as of now, based on section 45.2, you will be able to answer this much. So read only this much and calculate the capital gain. This is your homework for today. Tomorrow, first thing I'll discuss this question with you. Okay. Don't check the answers. Don't check. First try to solve. If you are able to solve, okay, no problem. And tomorrow when we will solve, then go and check the answer. Today don't check. Okay? Sure? So this is the end for today. We are meeting tomorrow, same time. And we'll continue from here. Okay, tomorrow we are going to finish 45.5 also, 46, 46A, and we'll enter into special aspects also tomorrow. Okay, so tomorrow many of the things in the capital gains we are going to finish. Many things are to be done tomorrow. So tomorrow's lecture is very important. Don't miss tomorrow. Okay, see you all tomorrow. Bye bye.